Good afternoon, everyone. My name is Faith Washington, and I work in the training division for HUD Learn. We are happy to have you guys here. We're going to go ahead and get started. Damian Robertson from TSP will be facilitating the course. To my people in the field offices, if you guys have questions at any time, please email me, and I'll be sure that the presenter answers your question. To my people in the room, you can ask a question at any time, but please be sure to come to the microphone. We have our field offices participating, and if you ask a question and you're not at the mic, they're not going to hear you. So just make sure you come to the mic. You can ask questions whenever you want, just come to the mic. We're going to go ahead and get started.
Good afternoon, everyone. As Faith shared, my name is Damian Robertson. I'm with the FRTIB. You all may ask, what exactly is the FRTIB? It stands for the Federal Retirement Thrift Investment Board. So I work as a TSP training instructor with the FRTIB. I've been with them for over about 2 years now, and I'm one of 8 colleagues that travels around the country, and we brief TSP participants on your retirement benefits. So what we're going to do today is a pre-separation presentation. That's for those who are about 5 years or less from retirement. Before I get into the presentation, I want to get a feel for the audience. I myself am about, let's say, 18 years away from retirement when it comes to FERS. So I got quite some time to go. But I'm retired military, so I'm working on the second pension. Now, with that said, how many of you all are 1 year or less from retirement? A show of hands. Well, congratulations to all of you, first of all, and that seems to be the majority of the crowd. Let's see, do we have any 5 years or less? The Ravens fan is in the back of the audience, those that can't see. If I would have known that before the presentation, I would have swapped out with another trainer, sir, because I'm an Eagles fan. But good luck to the Ravens anyway. So 5 years or less is the other half of the audience. And let's go with 10 years or less. 15 years or less? Okay, so I'm the only long-timer in the room today. Okay, so that's good to know. Do we have anyone under the old retirement coverage, the CSRS? A couple, well, 3 lucky ladies. Okay, thanks for sharing that information. I'll be sure to keep you in mind as I go through the presentation. It's not too many differences, though. Now, I'm assuming that everyone else is a FERS employee, and that's what we're going to focus on throughout the presentation. So let's get right into it. So what are we going to talk about today? Well, we're going to talk about the 3 components of retirement income. I consider myself an expert in the first component, which is the TSP, and we're going to spend the majority of the presentation talking about the TSP, about 2.5 hours. But the other 2 components are also very important, and that's going to be your Social Security benefits as well as your OPM pension benefits. And what I share with participants whenever I give this presentation is, by no means should this be your only 3 streams of retirement income. The goal is to have as many sources of retirement income as possible. I know some of you all may have Roth IRAs out there. Some may have traditional IRAs at banks and credit unions. Some of you may have 401ks from previous employers. Some of you may have pensions from previous employers. So the goal is to bring all of those sources of income together when you're in retirement in order for you to be comfortable. But as federal employees, we know at the minimum we're going to have these 3 sources, which is your TSP, Social Security, and also your OPM pension. Now, I don't want to spend too much time on Social Security or your OPM pension, but I do want to share with you all some websites where you can get this information to help you plan for retirement. So first, let's talk about Social Security. The Bible for Social Security is ssa.gov. Could I see a show of hands of those who've already established an account on ssa.gov? So quite a few of you, almost half of the room. If you haven't done so, I would urge you all to do so as soon as possible, no matter how far away you are from retirement, because it's going to help you plan for what your retirement income may look like. Now, when it comes to Social Security, does anyone know the earliest that we're able to claim Social Security? So 62 years old. Now, there's also 2 other important numbers when it comes to Social Security. It's your full retirement age, which is going to be either 66 or 67, based on your year of birth, and also the maximum age, which is 70 years old. And each year that you defer Social Security, starting at 62, when it first becomes available, you're going to get a rate of return increase roughly each year that you defer it. Does anyone know what that rate of return increase is each year that you defer Social Security from 62 to 63, so on and so forth? It's about 8%. For the first few years, it's about 6%, but the later ones, it's 8%. So with that said, when you think about Social Security, It's really not a bad deal, especially when you compare it to your TSP. Think about your TSP for a second. Are we guaranteed an 8% return year after year after year? What do you all think? We're absolutely not promised an 8% return in the market, depending on what's going on in the market. And I'm not sure if you all have been looking at the market this year, but I have. I've been following the market, and it's been doing this roller coaster ride. So if you're looking at the C, the S, and the I fund, you are up in value year to date, but most of that value is a return from last year when you lost money in your account. So when you think about your TSP and compare it to Social Security, it's not a bad deal. So you may want to consider deferring Social Security if it makes sense for you. Another factor with Social Security is your family's life expectancy, and that's another consideration. And when I look at the Robertsons family's life expectancy, we tend to check out in our late 70s. So unfortunately for me, I may not be able to defer Social Security. Maybe it's going to be most beneficial for me to claim it as early as possible. Either that, or I need to start working out or eating healthier, which I haven't started doing yet, but I need to make that change at some point. So Social Security is a very important factor. Now, another website that I wanted to share with you all to kind of calculate what your Social Security may look like is a website called consumerfinance.gov. You can also get to this website by going to cfpb.gov. That stands for the Consumer Finance Protection Bureau, another agency here in Washington, D.C., and they have some really powerful calculators on that website. In the middle of that page, consumerfinance.gov, you're going to scroll down and you're going to see some dollar bills. Under those dollar bills, you're going to see 3 calculators. One is for buying a home, one is for planning for college, and the last one is planning for retirement. All great calculators, but I would want you all to check out the planning for retirement calculator because that is a Social Security calculator, and it's going to let you know what your monthly amount will be based on your current age and your current salary. And it's pretty accurate. I've shared it with Social Security, and we've looked at the numbers, and they're almost right on. And the only information you have to provide is your date of birth and also your highest annual salary. So we've talked about Social Security. Let's talk about your OPM pension really quickly, whether that be CSRS or whether that be FERS. And when it comes to FERS employees, well, CSRS as well, the Bible for all of our pensions is opm.gov. Once you're on opm.gov, you're going to click on a retirement link. From there, you're going to choose your retirement coverage, and it's going to be a wealth of information. I want to focus on the calculation for the FERS annuity with this presentation. Don't want to take up too much time talking about FERS annuities, but could someone share with me what 3 factors are used to calculate our FERS annuities? And I'm going to repeat it after you all share so everyone can hear us that may not be here in the audience today. What 3 factors are used to calculate our FERS annuity? So years of service, that's one. The high 3 salary, that's another. And the last is a multiplier. Does anyone know what the multiplier is for the FERS annuity? It's a 1% multiplier. So think about your FERS annuity for a second. It's a really easy calculation, and I want to share with you all a scenario on how easy this calculation is. Let's assume that we all make $100K in this audience, and I know that's like a pay cut for some of you all in the audience. And let's also assume that we're all TSP millionaires, and I'm going to be using those 2 facts throughout the presentation. When it comes to the FERS annuity calculation, if we're making $100K, and let's say we do 20 years of service, and then we have that 1% multiplier. You multiply those all together, so 100K times 20 years times 1%, how much of an annual annuity will we have based on those 3 figures? 100K times 20 years times 1%, the annuity would be $20,000. And that's how easy it is to calculate your FERS annuity. Now, what I'm hoping to do, if I'm healthy enough and I'm still enjoying my job, I want to stick around until I'm 62 years old with at least 20 years of service. Because if I'm able to do that, my multiplier is going to increase by 0.1%. So it's going to go from 1% to 1.1%. So let me give you all an example for someone who's going to stick around for 20 years and wait until they're 62 before they retire and defers. So let's say I make $100K. Let's say I do 30 years. I retire at 62, and my high 3 was $100,000. My annuity in that scenario is going to be $33,000 instead of $30,000 because of that extra 0.1%. And that's what I'm hoping to do. Now, once you know those amounts from your Social Security as well as your OPM pension, you can kind of back into what your need will be for your TSP. And throughout my travels, I often get asked the question, how much money should I have in my TSP? And that's a loaded question, because we all have different expenses, we all have different sources of income, so I back into it a different way. The first thing that I ask participants is take a look at your fixed income sources first. And I've already shared with you all the 2 fixed income sources that we will have in retirement as federal employees, Social Security and also your OPM pension, whether that be CSRS or whether that be FERS. So with that information known, let me share some figures with you all that may be realistic of what you may see when you're going into retirement. I used to work as a financial planner in the Washington, D.C. area, so I worked with a lot of people who looked just like you all, either military members or civilian federal employees just like myself. And when it comes to your Social Security benefit, most of us in the room are probably going to have a benefit around $20,000 to about $30,000. That's a realistic amount to expect from Social Security. It may be a little bit higher, but somewhere within that range. So for the purposes of this presentation, let's say $30,000 is what we're going to receive from Social Security. You know, when it comes to that OPM pension, let's assume that's going to be another $30,000. You know, when I talk to FERS employees and we go over calculations for the FERS annuities, most times they're really, I guess I would say they're a little, when I tell them what the amount will be, they're like, wow, it's not going to be higher? So the realistic amount when it comes to that FERS annuity is about $30,000. So far, without even looking at our TSP, we already have $60K of fixed income. Is everyone with me so far? $60K of fixed income? So now we're able to try to figure out how to pull money out of our TSP. So 2 things I want to share with you all. There's 2 rules of thumbs to try to figure out how much you're able to take out of your TSP. The first is called a replacement ratio. A replacement ratio says this is a percent of your current salary that you're going to need in retirement in order to be comfortable. So question for you all, out of your current salary, what percent do you feel that you're going to need in retirement in order to be comfortable? What do you all think? What percent of your current salary do you think you're going to need in retirement to be comfortable? So I heard 80%. Anyone else? 100%. That's what I was looking for, sir. Thanks for helping me out, because I get that pretty often. So the rule of thumb is actually a range, and that range is 70 to 80%. That's called a replacement ratio. So we're going to use the average of that. The average is 75%. Remember, we all make 100K in this room. So 75% of 100K is at 75,000. But remember, we already have 2 fixed income sources totaling $60,000. So how much would we need to generate from our TSP to get us to 75,000? 15K. All right, so how can we figure out if we can generate that 15K for the rest of our lives? It's another rule of thumb in retirement planning. It's called the 4% rule. Could I see a show of hands of anyone who's heard of the 4% rule before? Thank you. So it's quite a few of you all who have heard of the 4% rule. So the 4% rule is what we call a safe withdrawal rule. And what happens with the 4% rule, if you're working with a financial planner or you're working with an investment company, they're basically saying to you that you can safely take out 4% of your TSP account balance or any other investment account for the rest of your life without ever running out of money. So let's think about that 4% rule for a second. You know, when you think about what the market does on a year-to-year base, the 4% rule is relatively easy to generate every year. And once you start taking out more than 4% from your account balance, it's going to get harder and harder to offset that with the growth. So if you're taking out 6% of your account value every year, it's going to be hard to generate 6% in the market every year. But 4% has been proven as a reasonable amount that you can attain in a market every year. Maybe you're mostly in the G fund, a little bit in the C, a little bit in the S. You can generate a 4% return. You know, think about that for a second, because I know some investors are all in the G fund. Could someone share with me what the G fund has returned, let's say, for the last 3 to 5 years? Anyone have any idea? Someone says 2%, and they're right. That's just about right. I would say it's probably averaged about 2.5%. But if you're in a G fund 100%, and you're using this 4% rule, what's going to happen to your portfolio value? It's going to go down. You're going to outlive your money. And that's why it's important to have a strategy when you go into retirement of a withdrawal strategy that's going to withstand your life expectancy. So again, the 4% rule has been proven. You know, I would urge you all to Google that when you have a chance, and you'll see that it's a lot of critics of the 4% rule. Some says it's great, others says it doesn't work, and I would say to you all to come up with your own conclusion, but it is a rule that the financial services industry uses, and if you work with a financial planner, you're probably gonna hear about it. So again, you're taking out 4% every year, and you're gonna offset it with 4% growth, and that way you're never gonna run out of money because you're flat every year. Now, let's put that into play. With all of us being TSP millionaires, if we use the 4% rule, how much money can we take out of our TSP every year? 4% of $1 million. $40,000. So when we add that $40,000 to the other income sources, Social Security and your OPM pension, how much money will we have in total in retirement? 100K. So sir, who said he needed 100% in retirement, I made you whole. The only key to it is you gotta make sure you have $1 million in your TSP to make this scenario work. Well, let's talk about that for a second. Because once I mentioned TSP millionaires, a lot of folks say to me, Damien, is that realistic? What are my chances of becoming a TSP millionaire? Well, every quarter at the headquarters at FRTIB, we get a report called the TSP Millionaires Report. The last time I checked that report, we had about 25,000 TSP millionaires. You know, with that 25,000 TSP millionaires, we saw some trends with those millionaires as well. The first trend we noticed was that they were invested in 2 funds since the inception of TSP. Does anyone have any guesses on what those 2 funds were? That was one of them. The C fund was one of them. And the S fund was the other. The S fund was the other fund. So it was a United States stock market, basically, since inception. So the C fund is the larger companies in the United States, where the S fund is the small to medium-sized companies. And that's what the TSP millionaires were invested in based on the trends that we saw. And we also saw that they were maximizing the contribution limits very early on in their careers. Does anyone know what the contribution limit is for this year in 2019? So someone said 25,000, the other said 19,000, and you're both correct. So 19,000, absolutely, yes ma'am, you're absolutely correct. So 19,000 is a regular contribution limit, and then if you're the calendar year that you turn 50, you're able to do an additional 6,000, which brings you up to 25,000. So you both were correct. Now, these TSP millionaires were maximizing these limits very early on in their careers. Way back in 86 and 87, of course, those limits were a lot less than they are today. Now, another thing that we saw with some of these TSP millionaires is they cheated. And I say that jokingly. When I say they cheated, they transferred money from outside accounts into their TSP. And that's how they became TSP millionaires. And I'm a cheater too, because as soon as I came on with the federal government, I reached out and grabbed some old 401ks that I had in the financial services industry over into my TSP when I became a federal employee. Now, the largest TSP balance I've seen on the TSP Millionaire Report was about $6.6 million. You best believe that person cheated, because there's no way possible for you to accumulate $6.6 million over less than a 30-year period with contribution limits. So they brought a lot of money over into their TSP. And we are able to bring that money over as well, and I'll talk to you all about that later in the presentation. The average account balance is about $120,000. So if you're already at $120,000, give yourself a pat on the shoulder, you're above average already. So far, we've talked about rules of thumbs. I've told you all about the replacement ratio, which the average is 75%. And I've also shared with you all the 4% rule, which is what they call a safe withdrawal rate. Let's talk about some other ways to get an idea of what retirement may look like for you. So far, those rules of thumb, some of you may say, Damien, I need some more concrete evidence. Those rules of thumbs, I'm not comfortable with that. But we have some pretty powerful calculators on tsp.gov. The calculator we have on this slide is called the ballpark estimate, and we actually borrowed this from OPM. If you were to go to the OPM website, you're going to see the same calculator called the ballpark estimate. Now, this calculator is going to take some time out of your day. It's probably going to take you 20 to 30 minutes to use this calculator, but it's very comprehensive. You're going to have to bring a lot of information to the table, though. The information you're going to have to bring to the table is your monthly Social Security amount, but we know where to get that information from. You can go to ssa.gov or consumerfinance.gov. We're also going to need to know what your FERS pension is going to be on a monthly basis as well. And I've already shared that with you all. Your salary, your high 3 salary times your number of years of service times 1% or 1.1%. So that's an easy calculation. What I didn't share with you all is the calculation for CSRS. So let me do that very quickly because they have a more complicated calculation. Their calculation is based on 3 multipliers instead of 1 multiplier. So they use the same factors, the high 3 salary and the years of service, but their multiplier for the first 5 years of service is 1.5%. For the next 5 years of service, they have a 1.75% multiplier, and for every year over 10, they have a multiplier of 2%. So we can see how the CSRS pension is going to be a much higher amount than a FERS employee due to the higher percent they're using as their multiplier. So that information is going to be needed when you use this ballpark estimate. They're also going to ask you one question that I don't like, and that question is how long you're going to live. And if you know the answers to that question, I need to get what you do on the break, because you know the secret to life. But what I will say to you all with that question, and as a former financial planner, we're spending a third of our lives in retirement. So we may have to run different scenarios, maybe for 20 years, maybe for 30 years, and sometimes even for 40 years. Last question they're going to ask you is, what is your expected rate of return when it comes to your investments? And that's also a hard question. If you're in a G fund, maybe not, 2% roughly. But what if you're in the C, the S, the I, one of those life cycle funds? It changes every year. It's based on market performance. So what I would say to you all to get that expected rate of return, go to tsp.gov, click on the investment funds link at the very top of the page, choose the funds that you're in, and you're going to see different averages. You're going to see the year to date. You're going to see the 1 year, 3 year, 5 year, since inception. Use those longer time periods because it's going to give you some more realistic expectations of what type of the returns to expect. But again, a great calculator is called the ballpark estimate. Another website that I wanted to share with you all that's not sponsored by TSP, but it's a great retirement planning website, and it has multiple retirement calculators on it. It's called dinkytown.net. And I know that sounds like it has nothing to do with investments or TSP, but it's a great website, and I use it all the time personally. Again, that website is dinkytown.net, and that's spelled DINKYTOWN.net. Check it out. It's a great website. So what are some considerations as we're approaching retirement? Well, the first is your contribution limits are an annual limit. So what we mean by that and why we share that with you all in a pre-separation course is a lot of federal employees will retire during the middle of the year. And they may have maxed out their TSP during the middle of the year before they retire or separate. And what happens is they go to a civilian job in the private sector, and that job may have what's known as a 401k, and they run into a problem. And the problem is 401ks and your TSP, they share the same annual IRS limit of $19,000. So it's going to be up to you as a participant to keep track of what you place in your TSP before you go over to that civilian job and start contributing to a 401k. And the reason for that, again, is your 401k is not going to know what you put in your TSP, and your TSP doesn't know what you put in that 401k. So you have to keep track of that yourself. So be aware of that as you're going into retirement, especially if you plan on working another job that has a 401k or a 403b and some other qualified accounts. They do go by the same annual contribution limit. So let's talk about the contribution rules. So all FERS employees, new and rehired, are going to be automatically enrolled at a 3% contribution rate. Now, they can choose to opt out if they want to. Not a great idea, but they can do so. And I have even better news for you all. Starting in January 1st, 2020, we're going to increase that automatic enrollment to 5%. And I'm glad that we're doing so because it's going to help out the young federal employees not to miss out on that free money, that matching money. So I'm glad they're increasing it to 5% on January 1st of next year. You know, the money that you put into your TSP, it doesn't have a vesting requirement. Could someone share with me what a vesting requirement is? What does vesting mean? Yes, ma'am. And I'm going to repeat what you say. So the lady said that the money's not yours until you reach a certain period of time with your employer. And she's absolutely correct. That's exactly what a vesting period is. So I want you all to know that the money that you put into the TSP, it doesn't have a vesting requirement. That money is yours from day one. You don't have to do 3 days, you don't have to do 3 months, you don't have to do 3 years. That's your money from day one. TSP is not going to penalize you. However, there is another agency, and they're a 3-digit code that may penalize you. Does anyone have any guesses of what the other agency is? It's called the IRS, that's right. The IRS may penalize you if you're not quite 59 and a half yet. You may have a 10% early withdrawal penalty, and if you haven't paid taxes, which means you're traditional, that means you're gonna have some tax liability as well. So TSP is not gonna penalize you on your money, but the IRS may penalize you on your own money. Now, let's switch gears and talk about the money that our agency or our services provide us. So the agency contributions, there's two sources. Now, normally when I ask what amount does our agency provide us, I just get a flat out 5% match. But it's actually broken down into two different sources. First, we have what's called an agency automatic contribution, which is always 1% for all federal employees. It's part of our benefits package, other than CSRS, that is. Now, with that 1%, that does have a vesting requirement. For most federal employees, that vesting requirement is 3 years. So if we don't complete 3 years as a federal employee, TSP is going to keep that 1%, and it's going to be used to offset the cost of the plan to keep it extremely low. But only that 1%. It's called the agency automatic contribution. Now, what about the other 4% that our agency provides us, those matching contributions? Well, the good news is those matching contributions, they work just like our own monies. They don't have any penalties on them by the TSP. It belongs to you from day one, the 4% matching that you're receiving. Now, let's take a closer look on this slide to see how it works across the board based on the percentages that we're contributing. So let's look at that first row there. If we were to put 0% into our TSP, which means we've decided not to contribute, you see that we're still going to get the 1% automatic contribution from our agency. That's always going to be there. That's part of our benefits package. You're going to see that you're not going to receive any matching contributions, so you're going to end up with a total of 1% going into your TSP. Let's jump down to row number 4. If you were to contribute 3%, it's pretty straightforward. Your first 3% of contributions are a dollar for dollar match. So if you put in 3%, you still get that 1% from your agency. You get 3% in matching contributions, and you're going to end up with a grand total of 7% going into your TSP. Let's jump down to row number 6. What if you put in 5% to your TSP? Well, you're still going to get the 1%. The matching works a little bit different for percents 4 and 5. It's a 50 cents to the dollar match instead of the dollar for dollar match. So you're going to end up with 4% matching, and you're going to have a grand total of 10% going into your TSP. Anything above and beyond 5%, you're still contributing to your TSP, building that retirement nest egg, but you're not receiving any more matching contributions. Do we have any retired military in the audience? Okay, my Ravens fan in the back, the gentleman in the front row, and myself. And the reason I asked that, I wanted to share with you all a quick story. I went to, last year, a town called Texarkana, Texas. Has anyone been there before? It was absolutely in the middle of nowhere. But anyway, it's a base there called the Red River Army Depot. So I was giving a presentation at the Red River Army Depot, and a sergeant major came up to me. That's the highest enlisted in the Army. And he had a question for me, and he was also a dual civilian employee. And he said, Damien, my wife told me that I shouldn't contribute anything greater than 5% to my TSP as a FERS employee because I won't get any additional benefit if I go above that amount. And he asked me, what did I think? And I said, Sergeant Major, I think you should do whatever your wife tells you to do, is what I think, actually. And he's like, no, Damien, be honest with me. And I was like, no, Sergeant Major, don't stop her at 5%. Continue to contribute to your TSP, especially with the recent tax law changes. And I'm not sure if you all have noticed changes in the tax law, but this year, when I filed my taxes, I did what's known as a standard deduction instead of an itemized deduction. And the reason that I share that with you all in this course is because the recent tax law changes in 2017, it wiped away a lot of those itemized deductions. So we're stuck with the standard deductions. And that leaves your TSP, it may be your greatest tax deduction with these new rules in place. Think about it for a second. When I asked you all how much you can put into your TSP, someone yelled out to me $25,000. If that's going in traditional, that's a $25,000 tax deduction. You're lowering your tax bill and you're building your retirement nest egg. That sounds like a pretty good deal to me. And if you're doing Roth contributions, you're giving yourself the potential to grow some money tax-free. $25,000, you're giving it the potential to grow tax-free as long as you leave it in the account for at least 5 years and you're 59 and a half. Those are the two requirements for Roth TSP, and we're going to talk about that later in the presentation as well. So let's talk about those catch-up contributions. Now, when it comes to catch-up contributions, what do you all think? I'm going to throw a question at you. Does a catch-up contribution mean that you can go back to previous years and make up for those missed contributions? What do you all think? That's absolutely not what a catch-up contribution is. A catch-up contribution is basically the IRS saying to us, hey, you're getting a little bit closer to retirement, so we're going to allow you to contribute an additional $6,000 the calendar year that you turn 50 years old and all subsequent years as long as you're working. So it's a pretty good deal, and it's based on a calendar year that you turn 50. So I don't want you all to think that you have to be 50 to make the catch-up contributions. Let's use me as an example. If I were 49 years old this year, and my birthday is on December 31st of the same year, I could start making these catch-up contributions on January 1st of that year. I don't have to wait until my birthday, which falls on December 31st. So if that applies to you, and if you wanted to make those catch-up contributions, don't wait until your birthday. Start making those the first of the calendar year. You know, keep in mind with those catch-up contributions, they're only a dollar amount. We can't do percentages as we do with our regular contributions. Also, it requires a separate election form. The easiest way, in my opinion, to take care of the catch-up contributions is to go into your employee's payroll system to sign up for them. Be aware that they don't follow us from year to year like our regular contributions. And the example I would use is, last year, if you were maximizing your regular contributions, you were doing $18,500. It went up $500 this year. If you didn't make a change with your regular contributions, you're still doing $18,500. But the catch-up contributions don't work that way. They fall off after the calendar year. So if you were doing $6,000 last year and you haven't been into your payroll system, you're not doing anything this year. So make sure you sign up for your catch-up contributions every year. We also ask that you self-certify your... Yes, ma'am. When you ask a question, could you come up to the mic, please? Ma'am, I'm sorry, I can't hear your question.
She was asking whether you need to submit a manual form for the catch-up. When did that happen? I don't know when it happened, but it changed.
So when it comes to your catch-up contributions, you should be able to use a paper form and also your employee's payroll system. So it should be either or. You know, every agency has different rules. So your agency may have a different rule, but you would have to contact someone in the HR department to find out if it's different. It's a different rule there. But it should be available on both the payroll system and the paper form. Yes, sir. Sir, could you come up to the mic? I can't hear you all. Yeah.
I just want to say, I just started mine this year. I just want to say it works to everybody on the payroll system. I just started it this year.
Thank you
and
much.
I did it on the payroll system.
Thank you for confirming. Hey, sir, could you answer this question as well? What is your payroll system called?
Thank you.
Is that right?
Yeah, it's the NFC payroll.
NFC. Okay, thank you. Thank you for answering that question. So these are, yes, ma'am.
I have a question.
Sure.
You said the maximum contribution, like for 2019, is $6,000, right?
Mhm. Yes, ma'am.
Could that be from another account, or do you have to have it out of your payroll?
So it has to be payroll deduction. So it has to come from, unfortunately, your agency. You aren't able to write us a check or do a transfer from a checking account or a savings account. You know, again, we do ask you to self-certify your intent to make regular contributions up to the elective deferral limit. You know, so what are we saying there? Basically what we're saying is we don't want you to miss out on all of that free money. And this is an example to help you all make sense of that situation. I was giving a presentation in Detroit about 2 years ago, and after my presentation, a young lady came up to me who had just turned 50 years old. It was towards the end of the year. And she shared with me that she had maximized her catch-up contribution. And I said to her, congratulations, you were able to get $24,500 into your TSP because the regular contribution limit last year was $18,500 and the catch-up was $6,000. And she said to me, no, I only put $6,000 into my TSP. And I said, no, that's completely backwards because that $6,000 that she put in towards the catch-up contributions, it didn't receive any matching. So she left all of that free money on the table. And that's why we want you all to maximize the regular contributions first before you do those catch-up contributions. Now, it's perfectly okay to max them out at the same time. And I see a lot of federal employees, they will do the math at the very beginning of the year. They will say the $19,000 is the limit for regular contributions. They'll say $6,000 is the limit for catch-up. And then they're going to divide it by the number of pay periods, which is 26 for most agencies. And they're going to max it out per pay period over the course of the year, and they'll be able to maximize them both. Yes, sir.
Right, just going back to that millionaire TSP is because they put some money into it to make it. But from what you're saying, the max we can put in is $25,000 for 2019. That's a max.
Yes, sir.
Even though I won the lottery, I can't put nothing more in there.
Unfortunately, you can't. I wish we
right.
could, sir, but you can't.
So
Yeah.
if we're putting in the max for 30 years, and we'll be millionaires, you're saying.
Well, it depends. If you're in a G fund for 30 years,
Yeah.
you may not be a millionaire. You know,
Okay.
so it depends on how your investment strategy
I just want to
is.
make sure there's no other money we can put in there. But
No,
there's too much.
no, sir. And sir, about 5 more slides, we're going to talk about how to bring money into TSP, and I'm going to talk about all of the qualified accounts that can come from the outside into your TSP. But we can't just write a check and deposit it into our TSP account. But I'm going to make sure I cover that in detail for you all, so it's some clarity for that question. Yes, ma'am.
Question on the 6,000, I guess the catch-up primarily. Can that money be, can you contribute to a non-TSP IRA, IRA fund? Can you invest your IRA money outside the TSP?
Can you invest your IRA?
Instead of increasing my contribution through payroll?
I think I know what you're asking. I think I know what you're asking.
Could I put it in a fidelity fund or something?
So your TSP limits are totally separate from IRA limits on the outside. So the next question would be, can I contribute to my TSP and my IRA on the outside? And the answer is yes. The next question is, does the IRA on the outside have a catch-up contribution? The answer is yes, along with your TSP, and they're all totally separate. So here's an example. I'm going to max out my TSP this year. I'm 52 years old. I'm going to put $19,000. I'm not 52 years old. I'm going to put $19,000 in my TSP, and then I'm going to put another $6,000 for my catch-up contributions. Then I'm going to turn around and I'm going to go to a local bank, and I'm going to open up a Roth IRA because I fall within the income restrictions for a Roth IRA. But I'm over 52, so I also qualify for a catch-up contribution for my Roth IRA, which happens to be $1,000 additional for calendar year 2019. Does that answer your question, man? Or did I just dance around it?
So there are IRA limits which are higher than the TSP limit?
They're less. So your IRA limits for this calendar year are 6,000 regular and 1,000 for catch-up. Your TSP limits are 19,000 for regular and 6,000 for catch-up.
25,000.
And it's the total of both. You don't get TSP plus IRA.
Yes, you can. You can do both of them. You can absolutely do both of them.
But they can't be over 25,000.
Yeah, well, you can put 25,000 into your TSP. That's a maximum.
Right.
Then you can turn around and put $7,000 into an IRA. They're totally separate. One has nothing to do with the other. TSP is for federal employees. IRAs is for all taxpayers who have earned income, as long as they are within income restrictions. Using me as an example, I contribute to my TSP, and I have a Roth IRA on the outside. One has nothing to do with the other.
Okay. Well, my question was a little bit different then.
Okay.
Because here at HUD, we have an IRA, a Roth IRA, and a traditional IRA.
Okay.
At least I do here. So can I take that money if I want to do my maximum contribution to my TSP?
No, you can't. So that money can't be added to the $25,000 that you're putting into your TSP. That money can only go into your IRA. So you can't say, I'm allowed to put an additional $6,000 in an IRA, but I want to put it in my TSP. You can't do that.
So you can't transfer your IRA or your Roth or your traditional and put it in the TSP?
So now that's another question. So an IRA can be transferred into a TSP. And that's a totally different process, though. So first we were talking about contributions. Now we're talking about transfers. So if you all can bear with me for about 5 slides, I promise you I'm going to clear this up for you when we talk about what can be transferred into your TSP, okay? All right, so catch-up contributions. Any more questions about catch-up contributions? 19,000 regular, 6,000 for the catch-up contributions. Uniform services rules. Does anyone have two TSPs in the audience? So one gentleman towards the back. Sir, the only thing I want to go over with you, since you have 2 TSPs, are you still a reservist? Okay, so this slide doesn't apply to you. I'll keep that in mind when we get to the slide for 2 TSPs. Here's a pretty important slide, everyone. This is maximizing your match. We have 2 federal employees. We have Ed and we also have Susan. So Ed and Susan make the same exact amount per pay period, which is $3,000 per pay period. However, they've chosen to contribute a different amount per pay period. So Ed has decided he's going to do $920 per pay period, where Susan has decided she's only going to do $731 per pay period. Now, let's look at what happens over the course of the year. First with Ed. So when Ed gets to pay period number 21, he's going to maximize the IRS limit. And his payroll system is going to reduce that last contribution to $600 because he's about to exceed the IRS limit. And he's going to be done for the year since he's reached that $19,000, so he's going to end up with $2,520 in matching contributions. And that's it. Now let's take a look at Susan. When she gets to pay period number 21, it looks a little bit different. She's only contributed $15,351. She's received the same amount in matching contributions, but she still has room to go since she hasn't reached that IRS limit just yet. So from pay periods number 22 all the way to 26, she's going to be able to continue to contribute to her TSP. And she's also going to end up receiving more in matching dollars than Ed did because the matching is based per pay period. So what did Susan do to end up with more matching than Ed? She made sure she had money going into her TSP every pay period. So how do we make sure we have money going into our TSP every pay period? We just do the math ourselves. That's where we take the number of pay periods and divide it by the annual limit. So again, Susan took the $19,000, she divided it by 26 pay periods, and it equals $731. That way, she's not only going to maximize the IRS limit, but she's going to maximize her match. Now, it's perfectly okay not to maximize the IRS limit. So I don't want you all to think that you have to look like Susan. If you're doing 5%, you're maximizing your match. However, you're not maximizing the IRS limit. This slide is only for those who are maxing the IRS limit of $19,000, and they also want to maximize the match of that 5%. And that's what Susan did. So remember how to do that. Just divide it by the number of pay periods, or you can go on tsp.gov and use our calculator. We have a calculator called How Much Can I Contribute? And that calculator will do the math for you. Even if you wanted to maximize the match and the limit over less than the entire calendar year. So let's say after we leave this presentation, you're saying to yourself, I want to be like those TSP millionaires and maximize the match and the limit. You're going to go to the calculator, how much can I contribute? You're going to say to the calculator how much you've contributed already. Maybe it's $10,000, so you have $9,000 remaining. The next question they're going to ask you is how many pay periods are remaining in a year. And where are we at? We're in October, right? We're in the middle of October, so maybe, I don't know, maybe we have 10 pay periods remaining. So you're going to take that $9,000, divide it by 10 pay periods, and it's going to be $900 until the end of the year to maximize your contributions. And that's, again, how Susan did it, and you're able to do it yourselves if you would like to. Any questions about this particular slide? Pay periods. So the question was, how did Susan come up with the $731 per month? And the answer is, she first had to find what the IRS limit was, which was the $19,000, and then she had to figure out the number of pay periods in her agency, which was 26, and that equals $731, and that led her to not only maximizing the IRS limit, but also the match. So you were right, yes, ma'am.
Okay, so the difference with Ed is that he just chose amount, like the $920 per pay period, right?
So the question is, what's the difference from Ed? And the answer is, if I had to guess, Ed probably intentionally chose $900 because he wants to maximize before he retired. So he was going to retire during the middle of the year. So he wasn't concerned about the match. He just wanted to get as much money into his TSP before he retired. That would be my guess. Yes, ma'am.
So you have to be careful, though, at the last couple pay periods because it's the IRS limit is for the calendar year, and some of the pay periods run into January.
Yep, every agency is different, but the
that's
statement that the lady made is absolutely accurate. You have to know the number of pay periods with your agency, and you have to know the calendar year that it's going to fall in. Now, with that, once you find that information out, then you can do your math where you're dividing the limit by the number of pay periods. So thank you, ma'am, for sharing that information with us. Any other particular questions on this slide?
We have a question from the field.
Okay.
If you are 50 or older and have been contributing catch-up amounts but do not reach your maximum contribution of $19,000 during the year, what happens to the catch-up amounts? Are there any penalties, or are they simply counted as a regular TSP contribution?
Okay, so the question is this. My intent was to maximize the $19,000 for the year, and I'm making catch-up contributions as well. However, something happens. I don't reach the $19,000, but I've already made the catch-up contributions. What's going to happen in that scenario? Am I going to be penalized? The answer is no. We're not going to penalize you. You're just going to miss out on that free money. So the only reason that we're encouraging you to check that block for your catch-up contributions is for your own benefit. You will not be penalized by the IRS nor the TSP if you don't happen to hit that $19,000 limit and we see that you made catch-up contributions. They will still sit in one bucket and one will sit in the other bucket, but no penalties. Any other questions on this particular slide or anything we've talked about so far? Sir, did you have a question? Sir, could you get a mic? Everyone, I'm asking you all for the mic for two reasons. One is because we have about 300 people in the teleconference world, and also I can't hear out of my left ear. I have an ear infection, everyone, so I'm only working with one ear. Thank you.
So the Susan's chart looks a little misleading. Looks like that needs to be reworked in terms of numbers, because it looks like as though she did not contribute anything for paycheck 22, 23, and 24, looking at those numbers.
Well, the pay periods number 22, 23, and 24, they're there. We just didn't list them.
Yeah, but if you add up that 15,351 plus those two, it becomes 1,900.
The numbers may be off a bit. What I'll do is when I get back to the office, I'll check the numbers to make sure they're accurate. Okay, so switching gears, everyone. When it comes to our TSP, the cost of the TSP is one of the lowest cost plans in the entire world. And that's one of the reasons that I came to TSP as a financial planner. When I used to work as a financial planner and I had my clients sitting down with me, I would share with them if they had a TSP, to leave your TSP there. It's nothing I could do with them at my firm that would be as cost effective as their TSP. And that's the honest truth. We're in a great retirement plan when it comes to TSP, and it wouldn't be beneficial for my clients previously to move their money to me because I had to charge double the price. So let's talk about the cost of TSP. We always do a one-year look back. So the cost of TSP is about 40 cents per every $1,000. That's known as an expense ratio, also known as an operating expense, one and the same. Those terms are interchangeable. You know, the way that I would ask you all to look at a expense ratio or operating expense is turn it into a percentage or a decimal. The decimal for this TSP is 0.040%. That's your expense ratio, 0.040%. So how do you pay that fee? Do you have to write us a check and mail it to us every year? Absolutely no. I would want you all to think of it this way. Think of it as reducing your investment return. If you end up with a 10% return for the year, after we factor in your expense ratio, you as the investor are left with a 9.96% return. Think about that for a second, everyone. Out of 10% with TSP, we get to keep 9.96% of our return. That's a great deal, everyone. If you take a look at the investments on the outside, which I have, it's not even close. It shows you here that the average 401k is about $4.10 per every 1,000. If you were to turn that into a percentage, that's going to be 0.40 instead of 0.040, which is TSP. I've seen expense ratios as high as 3% in the outside industry, meaning if you had a 10% return, you as the investor are only able to keep 7%. So take advantage of the TSP while you're able to, because it's a great low-cost plan. Now, since this is a pre-separation course, I wanted to share with you all what other expenses you may see out there with financial planners and other investment companies. These fees that I'm about to share with you all TSP doesn't have any of these expenses. You won't find these expenses at TSP. The second expense that you may run into, we've already talked about the operating expense, but the second expense you may run into is called a sales charge. A sales charge will reduce your investment principal from the jump. If you invest $100,000, it could be as high as 5.75%, so you're going to pay that $5,000 off the jump. If you don't pay it on the front end, you may have to pay it on the back end, and it's called a contingent deferred sales charge. I share this information with you all, not to say these are bad fees, but I think we should be on equal playing ground as the financial advisors and the institutions we're working with. So be aware of sales charges. Number 2 expense. The number 3 expense, and this one is getting really popular, it's called a management fee. Management fees are going to be charged to your portfolio over the course of the year, and you will pay this fee out of pocket. They range from anywhere as low as 1%, maybe a little bit lower, and I've seen it as high as 3%. Again, these are charged to your account regardless of performance. Does anyone remember what happened to the market in 2008 if you were in the C, the S, the I, or any of the life cycle funds, 20, 30, 40, 50? The market did one of these numbers. You had about a 40% loss in your account value. Well, guess what? If you had a management fee, you were still charged at 3%. So instead of a negative 40% loss, you had a negative 43% loss. So beware of management fees. Again, not bad, but just be aware of what you're paying. The last fee that I wanted to share with you all is what got me when I retired from the Army. And this fee was called a maintenance fee, also known as a custodian fee. And this is a fee that you're going to have to screw up your statements, because these fees, they're going to charge you quarterly, maybe semi-annually, or maybe annually. What I found on my statement was a quarterly fee. I was paying $50 a quarter. And on top of that, I was paying another fee that I didn't even share with you all. It was called a transaction fee or a trade fee. Every time I placed a trade, I had to pay a fee. So beware of that. And last but not least, you may also run into what's known as a transfer or a closeout fee. This is going to be a one-time fee to either close out your account or to transfer your money over into TSP. And in most instances, it makes a lot of sense to just pay that fee, get it out of the way, and move it over to the lower cost plan, which would be the TSP or maybe something else that's out there that you're interested in. You know, with that said, let's take a look at how this expense affects the growth of our accounts over an extended time period. So we look at the first row there, that's for a 10-year investment time period, and we're basically comparing the TSP to the average 401k, and you all see in that last column in the blue, the 401k would be $344,000, where your TSP would be $356,000. So even after 10 years, you're starting to notice that difference. But let's jump down to 30 years. After 30 years, the 401k is about $1 million, where the TSP is $1.1 million. So that's an additional $100,000 by staying in that low-cost plan. So again, I would urge you all to take advantage of TSP while you're here, and even stay with TSP when you retire or separate, because you can stay with TSP for life, especially with these new rules in effect, which I'm going to talk about later in the presentation. So how do we get money into our TSP? Well, it's a couple of ways. The first way is known as a direct rollover. And this is probably the suggested way to go about transferring monies into your account. You know, with a direct rollover, the accounts that you're able to move into them are traditional IRAs, and you're going to find this at banks, credit unions, or investment companies. I had one at an investment company. You're also able to transfer 401ks from private sector, and this is what I did. I had private sector 401ks. As soon as I came on board with TSP, I transferred them all out into my TSP because they were higher cost. If you've ever worked for local or state government, I used to work with a lot of DC police officers who had 457B plans. That's for local and state governments. So you may have one of those. That can come into your TSP. And last but not least, if you've ever worked for a nonprofit, universities, school systems, hospitals, you may have a 403B, and that also can come into your TSP. Some that aren't listed here are SEP IRAs and simple IRAs. These are business accounts, small business owners. And I see a lot of federal employees, once they retire or separate, whatever they have is a hobby, they turn it into an income generator. They put the income inside of a SEP IRA once they're retired, and then they transfer that money into their TSP. So you can continue bringing money into your TSP even when you're retired if you bring it through a qualified account. and the qualified accounts are what we just talked about. Let's talk about those for a second. Before you ask if you can bring money over to TSP, ask yourself this question. Is this a qualified account that the money is in? A qualified account means you're receiving some type of tax benefit. So if you're thinking about your checking account, think about that for a second. Do you get any tax benefit from a checking account? The answer is no. If you have enough money in that account and you're earning enough interest, you're going to pay taxes on that interest. The same thing with the savings account. Can't transfer money from those types of accounts. You can't transfer from a CD. You can't transfer from a joint account. If it has both you and your husband's or your wife's name on it, it can't come into your TSP. What do you all think? Here's a question for you. Can you transfer your spouse's IRA or 401k into your TSP? What do you all think? The answer is no, you can't. It has to be your own Social Security number that you're transferring into TSP. So again, it has to be a qualified account, some type of tax benefit, or what's called an employer-sponsored plan, meaning it's offered through your workplace. Those are the accounts that you can bring into your TSP. There are a few qualified accounts that can't come into your TSP, and they're listed at the bottom of this slide. Roth IRAs, educational IRAs, and also inherited IRAs. Those are the only qualified accounts that can't come into your TSP. Now, why would you want to transfer this money into your TSP? Again, because of the low expense ratio. Now, how would you go about this process? Well, you're going to have to complete one form from TSP. That form is called a TSP 60, a 60, TSP 60. It's a really easy form to complete. It's a one-page document. The top portion is all you have to complete, and it's just your personal information. The bottom portion, you're going to send it to the losing institution who has those assets. Before you send it to the losing institution, give them a call and ask them if they require you to complete their paperwork as well. 80% of the time, they're going to require you to complete their paperwork too. Their paperwork isn't going to be as easy as TSP's paperwork. It's not going to be a one-pager. It's probably going to be about 20 to 30 pages, and you're going to have to figure out what to complete on that paperwork because they make it a tedious process. So complete both of those forms, mail it together to the losing institution, and with a direct rollover, the money should come back directly to TSP, made payable to us. You should have no worries and no tax consequences there. That's called a direct rollover. Any questions about the direct rollover? This is a suggested way to go about transferring money into your TSP account.
Yeah.
Yes, ma'am.
I'm a little confused.
Okay.
I'm a little confused. At the top, you have traditional IRA that you can transfer in TSP, and over here you've got the Roth IRA that I'm assuming that you can transfer into a TSP, correct?
No,
So
so what we're saying here, so all of these accounts in this bucket can come into your traditional TSP.
Right.
And all of those buckets over there can go into your Roth TSP. However, we don't have Roth IRA up there. The Roth IRA is down here. It says you cannot move a Roth IRA. However, you can move a Roth 401k. So a Roth 401k would be my previous employer where I worked for an investment company. I had a traditional 401k, but I also had a Roth 401k through that employer, so I could transfer that into my TSP. But what I can't do is I can't go to my local bank that has a Roth IRA and transfer that into my Roth TSP due to this rule right here. You cannot transfer Roth IRAs into your TSP. It's
Okay.
an IRS rule.
Okay. And that's what I have at a
Yes,
bank.
ma'am.
I have another bank in another state.
Unfortunately,
So-
Roth IRAs can't come into TSP, but the great news is Roth IRAs are powerful accounts. I'm not sure if I would want to move my Roth IRA into a Roth TSP.
What about the traditional?
The traditional TSP can absolutely be moved into your traditional TSP.
So my Roth IRA cannot be rolled into TSP, but my traditional IRA can.
Correct.
Am I correct to say that?
Yes, you are.
From another institution.
Correct. That's
Okay.
absolutely correct. And let me share with you all why I shared with the lady why I probably wouldn't move my Roth IRA into a Roth TSP. And I'm jumping a little bit ahead of the presentation, but it's a perfect time to talk about it. And I'm going to introduce the first rule change right now. So the first rule change is the ability to make withdrawals from your chosen tax treatment. Previously, you could only make what's called a pro rata withdrawal. September 15th, the new rules went into effect. So what does that mean to us? So previously, if you were to take money out of your account, let's say you had 80% in your in your traditional TSP and 20% in your Roth TSP. If you were to make a $10,000 withdrawal, $8,000 would come from traditional, $2,000 would come from Roth. Does that make sense, everyone? That's the old rules. But with the new rules in effect, you can choose a tax treatment that you would like to take out of your account. It's no longer pro rata. You can say to us, hey, I just want my Roth money. I don't want to pay any taxes right now. Leave that traditional money there. Or you can say, hey, just give me my traditional money because my Roth money hasn't been in the account for 5 years and I'm not 59 and a half, so I don't want to pay any taxes. Or you could say, just give it from both portions, both tax treatments. So that's the first rule change. Now, the reason I said that, I'm probably not going to move my Roth IRA into my Roth TSP. And again, this is a personal decision. I don't want you all to base it on my biases here. But what I'm thinking about doing is right before I turn 70 and a half, does anyone know what happens at 70 and a half? It's called the required minimum distribution. At 70 and a half, the IRS requires us to take money out of our accounts if we're separated or retired. If we're still working, it's going to be deferred. But if we're separated or retired, at 70 and a half, we have to start taking money out of our accounts, even if we don't want to, from Roth TSP and traditional TSP. One of the only accounts, qualified accounts that is, that gives you a tax benefit, that does not have a RMD is a Roth IRA. So what I'm hoping to do is at 70 and a half, I'm going to transfer my Roth TSP to a Roth IRA. Once my money gets into that Roth IRA, I can grow that money for the rest of my life because the IRS never requires me to take money out of it. So what I'm hoping to have happen is I'm going to leave a lot, well, I can't say a lot of money, but I'm going to leave some money to my son that's tax-free, and he's going to be a happy camper, and he's going to go to the local casino and blow it all in one day. So that's what I'm hoping to do. So maybe you all will follow a similar strategy for yourself from transferring from your Roth TSP to a Roth IRA. I love my son, by the way. I'm just joking. All right, so that's a direct rollover. All right, so there's another way to transfer money into a TSP, and that's called an indirect rollover. Now, this is not the suggested way to go about the transfer. With the indirect rollover, you still have to complete both forms, the TSP 60 and also the losing institution's paperwork. The downside with the indirect rollover is the losing institution's paperwork is not going to have a block for an indirect rollover. So in order to complete an indirect rollover, you have to do 100% cash withdrawal. Whenever you do a cash withdrawal, what type of consequences do you create for yourself? You create tax liability for yourself. So what happens with the indirect rollover, you're going to receive a check made payable to you. It's going to be minus 20% for federal tax withholdings because the losing institutions is required to withhold that amount. Now, you're going to have to transfer that money into your TSP or another retirement account within a 60-day period. If it's not completed within that 60-day period, it's going to become a taxable event, which means it's going to be added to your current salary. So if you took a $50,000 distribution and we're planning to do an indirect rollover, you already make $100K, you don't complete it in that 60 days, you now made $150,000 for the year. You bump yourself into a higher tax bracket. And guess what? You're not 59 and a half just yet, so you also have a 10% early withdrawal penalty. So an indirect rollover can be dangerous if you don't complete it in the proper time frame. Now, also with an indirect rollover, you all may ask, why would I do this and risk paying taxes? Two reasons I've seen indirect rollovers used. The first reason is for someone who made a mistake on the paperwork, because that paperwork is complicated. And often you'll make a mistake and receive a check made payable to you, but it's easy to fix. You'll just reach back out to the institution to let them know this is not what you intended to do, and most times they'll work with you. The other instance is you want to use that money for leverage for 60 days. So maybe you have college expenses to take care of, home improvements, an emergency came up, and you're thinking that, hey, within 60 days, I'm going to receive an inheritance, or I'm going to go win the lottery, or I'm going to knock on my neighbor's door and borrow some money from them. One of those scenarios, I don't know. I don't have any neighbors who are going to loan me that much money. But anyway, you're using it as leverage. So here's a quick story about an indirect rollover. Working as a financial planner in the DC area, I had a client, and I'll never forget her. Her name was Maria. And Maria had most of her assets with the institution that I was working with. However, she left behind an $80,000 401k at her previous employer. So she came to my office one day and she said, Damien, I'm ready to go ahead and move this $80,000 from this old 401k into my IRA with your firm. So I said, okay, let me get the direct rollover paperwork ready for you, and we'll do this transaction without any taxes. And she said, no, I don't want to do a direct rollover this time. I want to do an indirect rollover. So I asked her why, and she wouldn't share the reason with me. So fast forward about 30 to 45 days. Maria scheduled an appointment with me, and she said, Damien, I got a problem. I asked Maria what was going on. She shared with me that she had went to a place called the MGM National Harbor. She told me when she was at the MGM National Harbor, her goal was to double her money. She wanted to keep $80,000 for herself and take the other $80,000 and transfer it into my IRA. It didn't work out for her. She ended up losing the entire $80,000. But that wasn't the end of the bad news. Maria was only 57 years old. She was also a high income earner. She made about $130,000 a year. That tax year, she was taxed at $210,000 worth of taxable income because that was added to her ordinary income. On top of that, she also had to pay a 10% early withdrawal penalty because she wasn't 59 and a half just yet. So why do I share that story with you all? Don't take your retirement checks to any of the casinos in this area or any other area. It's not worth the risk. So don't use an indirect rollover for that reason. Use it if you truly need to use the money for 60 days and you have a backup plan on how to get the money into the account. Faith, what time do we have? 1:36. Okay, we'll go a couple more slides.
Can I just ask one clarifying question? You were talking about your Roth TSP, and did you say that you could take your Roth TSP, withdraw it, and roll it into a non-TSP Roth?
Yes, ma'am. And
so you can take your money out of TSP and put it into, while you're still a federal employee, you can roll it out of TSP into a different Roth.
so no, you wouldn't be able to do that because you would have to be separated or retired
Got it. Okay.
before you're able to take your Roth TSP and move it over to a Roth IRA, which is an account that you can open at a bank, credit union, or investment company. But you absolutely can take your traditional IRA and move that into your traditional TSP. So remember, when it comes to Roth TSP, Roth IRAs can't come in, but Roth TSP can go into a Roth IRA. Does that make sense, everyone? So, okay, I'll say it one more time. So a Roth IRA from a bank, credit union, or investment company cannot come into your Roth TSP. However, your Roth TSP, once you're separated or retired, can go into a Roth IRA at a bank, credit union, or investment company. And that's where I said that's what I hope to do before I turn 70 and a half, because I don't want to have to take a required minimum distribution if I'm in great financial standing. But it only applies for that Roth money, because traditional money will always have an RMD, even if you put it into a traditional IRA. Yes, ma'am.
So the required minimum distribution is only for our TSP, not for 401k?
So that's a great question, and I want to make sure I'm clear here. So the required minimum distribution is for all qualified accounts except a Roth IRA. And that's why I say a Roth IRA is a special account. I'm not sure I would want to move it into my Roth TSP if I was allowed to, because it's one of the only qualified accounts that does not have a required minimum distribution. Does that make sense, everyone? Okay. All right, so with that said, let's move on, unless we have any other questions about moving money into our accounts. Okay. Faith, can you let me know when it's 2 o'clock? I'm going to give them a break at 2. Can you let, 10 minutes? Yes, ma'am.
Are we going to talk about moving other kinds of accounts to it, or are we done with that?
So the accounts that you're able to move into your TSP, they're all listed here. Traditional IRAs do have required minimum distributions.
Then I do have a question. I have a state 457.
Okay.
Why would I want to move it to my TSP?
So because of that middle statement. So the question, everyone, is, hey, I have a 457B. I used to work for the state. I'm trying to figure out, does it make sense to move it into my TSP or not? And my answer would be, you need to take a look at the expenses. Look at your statement, scrub your statement. Speak to the plan point of contact and ask them what the expense ratio is. And remember, your expense ratio for your TSP is 0.040%. It's going to be hard to beat that.
Mine's 0.0032%.
Well, that's even lower than TSP.
Okay.
That's one of the lowest expense ratios I've ever heard of in my entire life. You said 0.0032.
They brag they're the best state in the union.
It sounds like you're in a great place. It sounds like you're in a great place. All right, so let's move on, everyone. So we talked about indirect rollover. Let's talk about combining TSP accounts. So this is for you, sir, way back there, who has 2 TSP accounts. So you are able to merge your TSP accounts together if you have 2. You have to decide if it makes sense to merge them together. This is what I would ask you to consider before merging your accounts together. First, do you need a backup emergency account? If so, don't merge them together because your military account is now separated. Separated accounts have a lot more withdrawal options than active accounts. With the separated account, you could purchase an annuity, you could do installment payments, you could do partial withdrawals, full withdrawals, limitless withdrawal options for separated accounts. Active accounts, think about what we can do as active federal employees. We're kind of limited. We can do hardship withdrawals. That comes with penalties. Once we turn 59 and a half, we can do what's called an age-based withdrawal, but we have to wait until 59 and a half for that. And last but not least, we could do a loan. And we're capped with loans. We can only have 2 loans outstanding. So it's limited what we can do as an active account, but with a separated account, more withdrawal options. Another reason to keep them separated, you may say, I just want to have 2 different investment strategies. My civilian account is going to be my more conservative account. My military account is a smaller balance. I'm going to make that really aggressive. And the only reason I would probably merge them together is if you decide to work beyond 70 and a half. But remember, if you decide to work beyond 70 and a half, the IRS defers your required minimum distribution. So while you're working, if you're 70 and a half, you don't have to take money out of your account. The IRS is going to allow you to defer it until you stop working. So you can work into your 80s, your 90s if you want to, and you don't have to take money out of your account. However, once you separate, the April following your separation, that's when you have to start taking your RMDs. Yes, ma'am.
Separated from that same job?
From that employer. From that employer, yep. So what happens in that scenario with the gentleman that has 2 accounts, if he doesn't, let's say he retires after 70, well, let's say he works beyond 70 and a half as a federal employee, he doesn't have an RMD with that account. With the military account that was left behind, he does have an RMD because he's not a military member active. So what would make sense in that scenario would take that outside account, merge it with his own account, and now he doesn't have an RMD for either. Does that make sense, everyone? And I'm going to go a step further. What if you're 70 and a half, you're still working, but you also have traditional IRAs on the outside at banks, credit unions, or investment companies? Well, guess what? I'm probably going to move those into my TSP as well because I don't want to have to take money out of them at 70 and a half. I'm going to be able to choose when I retire, and then that's when I'm going to be required to take money out of the account. So the question is there a penalty to take money out of a traditional IRA and move it into your TSP? The answer is it depends on how you go about doing it. If you transfer it or roll over, those are interchangeable. They're actually different, but they're used interchangeable. It's not a taxable event. But if you were to go to that bank and make a withdrawal from that account, at that point, now you have what's called an indirect rollover. Because you've made a withdrawal, you've had 20% taxes withheld, now you have 60 days to get that money into the qualified account. That's the way where you have to be really careful with it. A direct rollover, you never touch the money. It leaves a losing institution, it goes to the TSP, it's not a taxable event. It's a TSP 60, and you also have to, the question was, is it 2 different sets of paperwork? So you have to use your TSP 60, which is the form used by TSP, And you also have to reach out to the losing institution to see if they have paperwork as well. Okay, so next we have age-based withdrawals. And Faith, we don't have to take a break if we don't need one. Okay, all right. So age-based withdrawals. So remember I mentioned that we have to wait until 59 and a half before another withdrawal option becomes available. So the first withdrawal option that I'm going to talk to you all about is called an age-based withdrawal. And I want to make sure I talk about those old rules because they highlight how great the new rules are. So let's talk about the age-based withdrawal and what the old rules were. The old rule for the age-based withdrawal was once you turned 59 and a half, you only had one age-based withdrawal, and that was it. You were done. And remember, an age-based withdrawal is what you're going to use while you're still in service. So while you're still in service, you can take money from your TSP, transfer it to an IRA or 401k on the outside, and it's not a taxable event. Or you can transfer it to your pocket, meaning your checking or savings account, and it is a taxable event. Now, with that said, you're still a federal employee, so you can still build that balance back up because you're still making contributions to your TSP. Let's talk about the new rules. So we went from one and done to one every quarter. So the new rules are going to allow us to do 4 age-based withdrawals per year in all subsequent years. So it's a big difference with these new rules in effect. And you may ask, what are participants using the age-based withdrawals for? The big one that I'm seeing is participants are looking for different investment options. And what I mean by that, when we think about the TSP, we have limited investment options. We have 5 core funds, the C, the S, the I, the G, and the F. And then we have 5 life cycle funds, the L income all the way to the 2050. But that's it. In the investment universe on the outside, it's all types of investments. You can invest in individual stocks, ETFs. You can invest in this stuff called Bitcoin and cryptocurrencies. For those of you who like gold, you can invest in gold, mutual funds. It's a lot of different investment options. So I see a lot of people using age-based withdrawals because they're looking for a different strategy and they're prepping for retirement. Maybe they're working with a financial planner and they want to purchase an annuity before they retire. So that's what age-based withdrawals are being used for. I'm also seeing participants taking a small amount out just to pay off a little bit of debt. But you have to be careful with the age-based withdrawal because you're still working. So you may not want to take out too much money because it's going to be added to your ordinary income and it may bump you into a higher tax bracket. So some folks say, I'm not going to use an age-based withdrawal. I'm going to wait until I'm separated or retired because my income drops then, and then I'll take a withdrawal through partial, and we'll talk about that later on. But this is an age-based withdrawal. Again, we're going from 1 to 4 every calendar year, and yes, you can deplete the entire account balance if you choose to because you're still a federal employee and you are able to continue to contribute to your TSP. Yes, ma'am.
What if I'm not 59? Can you come to the mic, please? The Phil can't hear you.
Okay, the scenario is if I'm not 59 and I'm retiring at 55, do I have to take it out? Can I just leave it there because I don't need it? Can I not do a withdrawal in my TSP? Can I wait till I'm 70?
So the answer is, can I stay with TSP for life? And the answer is yes, ma'am, you can. But once you leave federal service, you leave your TSP behind, we'll take good care of it for you. Okay, all right? Okay, yes, ma'am.
Okay, if you decide to keep, you're 55 and you decide to take a deduction after you retire.
A withdrawal?
Yeah, withdrawal. What's
Okay.
the scenario then?
So the question is this. I'm 55, I'm separated or retired, I'm ready to make a withdrawal. What am I going to be faced with? So the good news is you waited until the magic age to retire, which is 55. All TSP cares about is that you're at least 55 when you retire and you avoid the 10% early withdrawal penalty. Before we get into too much detail with that, if you all could bear with me on that one because it's going to be covered in detail later in the presentation, but I did want to answer your question, okay? All right, so let's talk about the withdrawal options that become available once we leave federal service. All right, so the first option that's available is a delayed withdrawal. And basically what that means is you don't have to do anything when you leave TSP. You can leave it behind because you can stay with TSP for life. And what can you do once you separate or retire? Well, you can still continue to make investment changes through what's called interfund transfers. You're going to have 2 interfund transfers per month, just like active federal employees, as you go into retirement. So what does that mean? You can still change your investment strategy. So you can say, hey, I'm going to go from the C fund to the L fund. I'm going to go to the L fund to the I fund, so on and so forth. You're still able to change that investment strategy in retirement. You're also able to still bring over those qualified accounts into your TSP. So again, if you have traditional IRAs on the outside, 401ks on the outside, what else? 403bs on the outside. You can still bring those into your TSP. What I'm hoping to do once I retire is a number of things. I have lots of plans, but I got 18 years to wait before I put these plans into fruition. But what I would like to do when I retire is use my TSP as a consolidation account. So hopefully what I'm going to do is work a couple of jobs after I leave federal service, and they're going to have 401ks. And once I leave those companies, I'm going to take those 401ks and bring it into my TSP because I'm allowed to do so. And the reason I'm doing so is because of the low cost of TSP. It's going to be hard to beat the cost of TSP. Another thing that I hope to do when I retire is work as a financial planner or a presenter. And with that, I'm going to be able to open up a SEP IRA. So I'm going to be able to turn a hobby into an income generator. And once I get money into that SEP IRA, every year, I can transfer it into my TSP. A SEP IRA is a business account, by the way. Or you could say, as long as you have earned income in retirement, meaning you're working part-time, full-time, business owner, you can still put money into a traditional IRA as long as you are within the income restrictions, and that money can be transferred into your TSP as well. Because I'm hoping to grow my TSP even when I'm in retirement. Now, a story, yes, sir.
What is the impact of marriage? That is to say, two people married, both earning income, both over 70 and a half, one with a TSP account, another with a 401k with their company and an IRA and some other stuff. Can you withdraw from the spouse's account and put it in the other spouse's TSP?
Sir, we went over that earlier. That's why everyone's
Okay,
shaking their
sorry.
heads.
Sorry about that.
No problem. No problem. You weren't here.
The answer is no.
Yes, sir.
Okay.
Yeah. No, sir. Okay. Moving on from the delayed withdrawal. Well, before we move on, let me tell you all a quick story of what happened to me when I retired from the Army. So when I retired from the Army, I was always one of those guys who was following stocks and bonds and in the investment universe. So I thought I knew everything about the stock market and capital markets, period. So I took my entire TSP account balance and I wrote it over into an IRA at an outside firm once I retired. And I was doing fairly okay when it comes to growth of that account, but then I started scrubbing my statements, and that's when I saw that I was paying those trade fees and also that custodian fee. So I finally got smart, and I called up TSP, and I said to TSP, what would I need to do to bring my IRA back into my TSP? And they looked up my account number and said, Mr. Robertson, we see that you made a 100% account withdrawal. And they said, unfortunately, sir, you can't come back to TSP. And at that point, they shared something with me which I wish I had known before I took my money out. They shared with me in order to come back, I would have needed to have at least a $200 minimum balance in my TSP. And that's why I'm sharing it with you all. If you decide to move your TSP balance over to another account, leave the minimum amount, which is $200. That way, you can always come back to TSP because we will never close your account down. Now, with that said, if you all decide to leave the minimum amount of $200, what fund are you going to leave it in? That's it. That's it. What fund is the safe one? The G fund, right? Because anything else could lose value. And if it drops below 200, you're going to be in the same boat as me on the outside looking in. And you may have to do the same thing I did. I had to go to this website you all may have heard of. It's called usajobs.gov. And luckily for me, they had a job for a TSP training instructor. So I looked up and got the job, and here I am. And guess what the first thing I did when I got to the desk at my office? I went out and filled a TSP 60, and I moved that money into my TSP. So I share that with you all because I don't want you to make the same mistake as me. So leave that minimum balance and also leave it in the G fund if you decide to leave it at $200. So next, what else are we able to do after we separate from service? So we've talked about what you can do while you're in service, but what can you do when you're out of service? Well, you can take a lump sum distribution whenever you want to. And let's talk about that. So the lump sum distributions are known as partial withdrawals. Now, the partial withdrawals had a big rule change as of September 15th. And the partial withdrawals was one of the reasons that participants left TSP after federal service or retirement is because we limited you to one partial withdrawal once you separated, and that was it. With the new rules, you're going to have unlimited partial withdrawals. The downside is it takes us 30 days to process them, so you're going to have 12 per year. But that's still a big difference from one period to 12 per year. So 12 partial withdrawals under the new rules. That's a powerful rule change. Now, what are participants using partial withdrawals for? Cars could be one, but I was thinking of some other reasons, and I want to share them with you all. The big one I'm seeing the partial withdrawals used for is paying off that mortgage. But I would say to you all, be careful paying off the mortgage, especially depending on how large it is, because it could bump you into a very high tax bracket and it could deplete your entire TSP balance if you pay it all in one tax year. So think about the new rules, the fact that they offer us multiple partial withdrawals, maybe pay it off in increments in multiple tax years. So pay off $25,000 the first year if you have a $100,000 mortgage, another $25,000 the next year, so on and so forth until it's eventually paid off. That way, you're putting that money into multiple tax years and not bumping yourself into the highest tax bracket all at once. Now, another thing that you could do if that mortgage is a concern is one of the most popular TSP withdrawal options. It's called the monthly installment payment. Just set up your installment payment for the amount of your mortgage. Now, keep in mind that you still have to manage your account, so you have to make sure you don't outlive that money, but that could address your need, and that allow you to deplete your entire account and bump you into a higher tax bracket. Another thing that I'm seeing with the partial withdrawals is participants are taking money out of their TSP, a small portion, and moving it over to a bank or a credit union IRA. And the reason they're doing that is because retirement is the unknown, and they may not have enough in emergency savings. So they're doing that as a backup emergency savings. So the rule of thumb for emergency savings is about 3 to 6 months of your monthly expenses. So I'm seeing participants calculate that amount, reach into their TSP, transfer it over to an IRA at a bank, which is not a taxable event. And the reason they're doing that is to give them some peace of mind in case an emergency comes up. They can go to the local bank, take money out of the account that day. If you were to leave the money in the TSP, you're going to have a higher interest rate, because I'm not sure if you all looked at the interest rate at banks and credit unions, but they're way low. But you're giving yourself peace of mind to know that you can get hands on that money that day. If you leave the money with TSP, again, you will have more earning potential, but it's going to be processing time for us to get that money to you. And you're also going to have to get the form to us. So you may not be able to get your hands on that money that day. So you may want to consider that as well. That's called a partial withdrawal.
How long would it take to get it through?
So the question was, how long does it normally take to process the paperwork for TSP once we separate? I would say give yourself 45 days. And I know that sounds like a long time, but I say 45 days for this reason. You have to wait 30 days in order to receive a separation code from your agency. We have to wait 30 days before you're able to take money out, because we have to see that you're coded separated. And then it's going to take us 7 to 10 business days to process your form. And I would encourage you all to fax it to us, because we're really fast with that fax. We process it right away for you. So I would say give yourself about 45 days after you separate or retire from service. Yes, ma'am.
Is there a age limitation on once you're separated, like the 59 and a half in service? Like if you retire at age 56, can you immediately, with no penalties, start withdrawing from your TSP?
Ma'am, if you could bear with me for 15 minutes, It's an entire section on that slide, and I'm going to quiz you all on it too. So everyone's going to be expert on that question later in the presentation. Yes, ma'am.
Just want to clarify, so you said your initial when you first separate, plan on 45 days before you might see your first distribution.
And
Once you've retired and you want to do a lump sum distribution, you fax in or email, whatever you do, the paperwork, how much time, that's not another 45 days.
7 to 10 business days.
7 to 10, thank you.
Yes, ma'am. Yeah.
I think my answer is there. Even though it takes 30 days, if I did a quarterly withdrawal or a monthly withdrawal,
So ma'am, your question is, how long would it take for me to do an installment payment? How long would it take
yeah, if
for it
I
to go?
set up for a quarterly or a monthly, say I had to set up a monthly withdrawal after I retire.
Still going to take 7 to 10 business days.
Oh, only 7, not 30.
No, not 30. Well, it's going to take 30 days for it to update.
Okay.
So let's say you have $1,000 already established as your monthly installment payment. And let's say you've realized that, hey, you underestimated, you need to go with a higher amount. So you reach out to us and say, I need to increase that amount. It's going to take 30 days for it to go into effect. Okay. So next, let's talk about the life annuity. Now, if you purchase annuity through TSP and annuity through TSP, you're going to end your relationship with TSP and establish your relationship with MetLife for that portion of money only. The rest of the money is still going to be with TSP. Now, an annuity is a transfer of risk from the participant to the insurance company. So annuities are for those who say, I don't want to worry about this market anymore, the ups and downs of the C, the S, and the I, these life cycle funds. I just need to have a guaranteed income stream that I can't outlive. That's what an annuity is. It's a transfer of risk from you to the insurance company. Now, it's also a bet against you and the insurance company, because you're betting to say to the insurance company to say, I'm going to live a long life, and not only am I going to recoup my principal, but I'm going to continue to receive interest payments for the rest of my life, because annuities have to pay you for the rest of your life, even after you've recouped your principals. So that's when you win the bet. When you've recouped your principal, you've lived a long life, and they still have to pay you. So MetLife wins the bet if they can get the first payment to you, and then you pass away. Because guess what? After that first payment is received, if you pass away and money is left, who keeps that money? They do, absolutely. That's how an annuity works. So you're going to have to weigh the risk with not being able to name a beneficiary. So let's talk about that for a second, because there are some different features. First off, I want you all to know the type of annuity that you're purchasing from MetLife. It's called an immediate annuity. So before you purchase this annuity, make sure you do comparison shopping, because you're going to find that in some instances, TSP has the best payout for the annuity. But in other instances, outside insurance companies may trump our TSP. Now, when you think about the expenses of an immediate annuity, there are hidden fees, kind of, sort of. And what I mean by that is you don't have to necessarily pay a fee, but look at it this way. You're going to give the insurance company one lump sum of money, and you best believe they're going to take that lump sum of money and reinvest it in another investment strategy. And that's how they're going to make money off of you. And the amount they're able to make is probably going to be greater than what they're going to pay you on a month-to-month basis. So that's how the insurance company makes money off of this immediate annuity. You don't have to pay any principal or fees per se. Now let's talk about the different types. So first we have the single life level payment. I'm here in the presentation. The single life level payment is the simplest form of the annuity, and it's always going to be the highest possible payout. So let me give you all a scenario, and I'm pulling numbers out of the air. This is not accurate. I just want to paint a picture. If you have $500,000 and you choose a single life level payment, let's say you're going to receive $3,000 for the rest of your life. But remember, with the single life level payment, if you were to pass away before the principal is recouped, who keeps it? MetLife. That's the single life level payment. I call it the Scrooge annuity. This is for the person who doesn't have any family, who doesn't have any dependents, who doesn't have any friends, and they just want the highest possible payout as long as they're alive. They don't care what happens to the money once they're not here. Now, the other options may be a little bit more interesting to you all. Next, we have the increasing payment. The increasing payment is based on the rate of inflation each year up to 3%. It's going to start off at a lower amount than a level payment. So I said the level payment would be roughly $3,000 per month. Well, the increasing payment is probably going to start off somewhere around $2,200 per month. But every January 1st, you're going to be able to increase the payment from 0 to 3% based on whatever the previous year's rate of inflation was. So that would be the option for someone who's concerned about inflation. Now, you still can't name a beneficiary on that option. The next option is a little bit more popular. It's called the cash refund. The cash refund, you are able to name a beneficiary. So you're going to name a beneficiary if you choose the cash refund option, and your payment is also going to decrease from the level payment amount. It doesn't decrease a lot. It's probably going to drop to $2,500 to $2,600 instead of $3,000, but you have the peace of mind to know that if you were to pass away before your principal is recouped, your beneficiary will inherit the remaining amount. And once they inherit it, they have the option to purchase their own annuity, or they could spend it, or they could roll it over into an IRA, whatever works for them. Last but not least, we have a 10-year certain, and that works kind of sort of like the cash refund. It's based on a 10-year period. Let's say you receive payments for 5 years, and then you pass away. Whoever you have named as a beneficiary is going to receive the same equal payments for the remaining 5 years, and then the payments will cease. You can also request joint life with spouse or joint life with other survivor as long as they have an insurable interest. We have 100% options, which means if one of the parties passes away, the survivor keeps the same amount. And we also have the 50% option, which if either party passes away, it drops by 50%. A lot of participants don't like the 50% option because of what I just said. It's based on both lives. And what a lot of participants say is if my wife passes away first or my husband passes away first, you mean you're still going to drop my payment by 50% and this is my money? And the answer is yes, we will. So you may want to do some shopping around before purchasing the 50% joint life annuity. Yes, ma'am.
If you do the cash refund or the 10-year certain and you die and your beneficiary receives the balance, is that taxable income to the beneficiary?
Unfortunately,
Or
it
is it
is.
estate? Okay, so it's
Unfortunately,
not
it is,
part of
unless
the
it's
estate.
Roth money.
Okay.
Yep. Now, the annuity is probably one of the least popular options, and the reason I think it is based on the fact that as federal employees, we already have annuities. We have 2 of them. We have Social Security, and we also have either our FERS or our CSRS pension. Those are both 2 income streams that we can't outlive. Those are annuities. Now, the reason what I am seeing with the annuity is people purchasing annuities for a partial portion of their balance for those expenses that are going to be there for the rest of our lives. So could you all help me out? What type of expenses are going to be there or bills for the rest of our lives? Utility bills. What else is out there? A mortgage may be there for the rest of our lives. Insurance payments may be there for the rest of your lives. So add those things up and say, you know what? I'm going to purchase an annuity that covers these bills that are going to be there for the rest of my life. That way I won't have to worry about them ever again, and I still have money left behind in my TSP. That's a pretty popular strategy for those who are worried about those bills that are always going to be there, and they could use a partial annuity to cover that. Any questions about the annuity? So next, let's talk about the installment payments. These are probably the most popular option. Yes, ma'am, could I get you to come to the mic, please?
Just a question on the annuity. Can you opt out of the annuity after a certain period of time, like private sector annuities? There's a 7-year period, on some annuities I've seen that once you reach that 7-year period, you can start withdrawing from the annuity and eliminate the annuity completely. Yeah.
So the question is, does the annuity purchased through TSP have what's known as surrender charges? Annuities have what's known as surrender charges. Now, another thing with annuities, it's a lot of them out there in the marketplace. Fortunately for us with TSP, the type of annuity that you're purchasing, which is an immediate annuity, doesn't have a surrender charge. So you don't have to worry about that 7-year or that 6-year or that 5-year period. That's for other types of annuities. That applies to what's known as variable annuities. It applies to what's known as deferred annuities, and it applies to what's known as index annuities. But it doesn't apply to immediate annuities, and that's what we are purchasing through MetLife, immediate annuities, so you don't have to worry about that surrender charge. So that's the good news. So let's talk about the most popular option, which is those installment payments. So 2 types of installment payments. And we changed the name of these payments as of September 15th. It used to be known as monthly payments, and we've just recently changed it to installment payments because you now have multiple frequencies. You are now able to request monthly, quarterly, or annual payments. Another change that took place with these installment payments is we got rid of open season. You used to only be able to change your payments between October 1st and December 15th. With the new rules in place, you can change it whenever you want to. It's just going to take 30 days for it to be updated. The old rules, you couldn't stop your payments. You could only reduce them to $25. If you didn't want to stay with TSP, well, if you wanted to reduce it to 0, we would require you to transfer your entire account out. You're no longer required to transfer your account. You can stop your payments if you want to. You can increase anytime you want to. You can decrease anytime you want to. And also with the installment payments, what if an emergency comes up? So let's say you're receiving $1,000 per month in retirement, but you have an emergency that comes up in July. You're now able to reach into your account, take out a partial withdrawal that doesn't stop your monthly installment payments. So again, the plan is becoming a much better plan and a much more flexible plan. And these are one of the most popular options. Yes, ma'am. I couldn't hear you. So the lady says, thank TSP for her, and I definitely will. I definitely will. It's made much more flexible. Thank you for that. Ma'am, can I get you to use the mic there? No problem.
Say I took out like $1,000 monthly, and I came into an emergency, and I needed some more money. Is there a penalty for doing just a withdrawal, just to meet what my needs are?
So no penalty just based on your needs, but it is based on your age. So if you're not 59 and a half, you may have some penalties. Of course, if you take money out of the account before that age. But you're not going to have a penalty just because you have that need. You're going to have the penalty. Your question is what, ma'am? If you're separated, will you have any penalties when you take money out of your account? Okay, that's where I want you all to bear with me, because we're going to come back to that one. And I promise you, once we finish with the question and quiz, you're going to know the answer to it. Yes, sir.
Okay, I just want to get clarification. You may have clarified before, but we got the requirement minimum distribution when we're 70 and a half years old.
Yes, sir.
Is that part of the installment that's above and beyond? I can do an installment in addition to that, I guess. I'm forced to take out a minimum requirement, right?
Kind of, sort of. And if I could hold off on that question too.
Okay.
Because we're going to cover RMDs, and I'm going to share with you if the installment payments will cover your RMD or not. And that's the question that you're asking me.
Right, yeah, I just want to make sure, because when I get into retirement, when I'm 70 and so forth, I want to know how much I can take out, how much I have to take out, basically, yeah.
And I'm going to come back to you, sir, when we get to that section to make sure I answer your question. And ma'am, in the back, I'm going to do the same thing for you once we get to the 55 question. And you too. And everybody else in the room as well. I'm going to answer all of your questions. Okay, so let's finish up with these installment payments. Now, remember with the installment payments, because this is the biggest mistake that participants make with the installment payments, they call us and they ask us the dollar amount they're able to take out. Remember, if you choose the installment payment, you have to tell us the dollar amount you would like to receive. So before you reach out to us, make sure you're running the numbers. I had a gentleman about 2 months ago. He had a $100,000 balance roughly, and he came to me and he said he signed up for monthly installment payments for $10,000 a month. And he asked me how long those payments was going to last. How long is that going to last, everyone? That's not even going to be a whole year. That's 10 months. So make sure you run the numbers before you give us a call. And we have a calculator on our website called How Long Will My Money Last? And it's going to project how long your money will last for you. So if you think about what's the risk with the installment payments, the risk is you may outlive your money if you don't calculate properly. That's the difference with the annuity. With the annuity, your risk is you don't have liquidity anymore because you can no longer reach out to the insurance company and say, let me borrow some money out of it. That doesn't belong to you anymore. In turn, you have a lifetime income stream you can't outlive. Now, we also have an installment payment called based on life expectancy. Now, we will calculate this payment for you. If you check on the paperwork that you would like monthly payments based on life expectancy, TSP is going to calculate it for you. We use two different figures. We use your account balance the previous year on December 31st. We also go to an IRS table called the single life table. Now, if you choose monthly payments based on life expectancy, it will fulfill your RMD exactly. It's going to be 12 equal payments that equal exactly what your RMD is. So that would be a great choice for those who don't need any money out of their account, but they know they have to fulfill their RMD because they're 70.5 and separated, and that's going to make sure they get the minimum amount. Another good reason for the based on life expectancy, if you all take a look at the second and also the fifth bullet, it says that it adjusts automatically, and it also, you may request a final single payment, but that doesn't go over what I wanted to share with you all. What I wanted to share with you all is one of the reasons that participants use the life expectancy payments is if they are not 55 or 59 and a half, and they want to avoid the 10% early withdrawal penalty. So let me say that one more time. Life expectancy installment payments will allow you to avoid the 10% early withdrawal penalty regardless of your age. So what if you were to separate early, let's say 50 years old? You aren't at the required ages just yet. You could sign up for monthly payments based on life expectancy, and you're able to receive money without that 10% early withdrawal penalty. However, it may not meet your need. And why we say it may not meet your need is just because it's probably likely to be maybe 3 to 4% of your account balance. So if you have $100,000 in your account, it's only going to be about $3,000 to $4,000 a year. But it does allow you to get hands on that money without that 10% early withdrawal penalty. Now be careful with it because it doesn't allow you a lot of flexibility. You have to keep those payments going until you're 55 or 59 and a half. Well, let me back up. Until you're 59 and a half or 5 consecutive years, whichever is greater. If you don't keep those payments going for that time period, the IRS is going to come back and recoup all of those missed 10% early withdrawal penalties. They're also going to come back and recoup those penalties if you do anything other than a monthly payment. So let's say emergency comes up and you have to reach out and take a partial withdrawal. The IRS is going to start penalizing you. So be careful with the based on life expectancy payments if you're trying to avoid the 10% payment because you're too young. And ma'am, can I get you to come to the mic? Thank you.
You mentioned R&B. In my head, I'm thinking rhythm and blues. So what was R&B?
RMD, Romeo Mike Delta. So that's required minimum distribution. Required minimum distribution. And I think we're going to talk about that next. Let's see. So this is an example of what most participants are doing with their TSP account balances. They're doing mixed withdrawals. Hardly do we ever see a participant only do one thing. And what this slide is showing you here is a participant has decided they're going to take 10% of their account balance and pay off some bills. So that's a single payment or a partial withdrawal. They're going to take 20% of the account balance and take care of those bills that are going to be there for the rest of their lives. And that's why they're purchasing an annuity. And last but not least, they're leaving the remaining 70% into their TSP. And if I had to take a guess, I would guess that the reason they're leaving that 70% is to cover their required minimum distribution. And how do I know? Because I see here, they didn't enter an amount. So this tells me that they want the payments based on life expectancy. So that will alert us to do the calculations for them based on their previous year's account balance on December 31st, and also on the IRS uniform life table that I'll show you all in a second. So this is a mixed withdrawal, and this is what I see most participants doing. They're mixing and matching different strategies. So next, we have another calculator that's pretty powerful for those who are interested in the annuity option. It's called the Retirement Income Calculator. You're going to be able to see the exact amounts based on your balance and potential growth that the MetLife annuity will pay you out. And we're going to go over the cash refund option. It shows you the life expectancy option. It shows you all of those annuity options in this retirement income calculator. So give that a look if you're interested in the annuity option, because it's going to give you all the payout options, real-time information. TSP.gov, and it's going to be under calculators and tools, and you're going to choose the retirement income calculator. So next, we have that required minimum distribution. So this participant's age 70 and a half and separated. That's key. You have to be separated or retired before that kicks in. You must receive and pay taxes on income from your TSP every year. The minimum amount of income is recalculated annually. The reason that we recalculate it annually is based on a couple of factors. Number one, the balance is going down or up every year. Number two, we're becoming older every year, so our life expectancy goes down, so we have a different factor. Now, your first year RMD must be received by April 1st of the year following the year that you turn 70 and a half. And I want to stop there for a second, because what I'm thinking I'm going to do when I turn 70 and a half, I'm not going to wait until the April 1st following the year that I separate. I'm going to go ahead and take it out by December 31st of the year that I turn 70 and a half. I don't want that exception. The reason I don't want that exception is because I plan on having a lot of money in my TSP by the time that I retire. And with that said, I don't want to have to take out 2 required minimum distributions in my first year in retirement. So if I wait until that second year, I'm going to have one due in April, and then I'm going to have another due in December. And if I'm a TSP millionaire, I'm going to have to take out $36,000 in April and probably another $38,000 in December, and that's going to bump me into a higher tax bracket. So I'm probably going to take it December 31st, the year that I turn 70 and a half, because I want to have it in different tax years. Does that make sense, everyone? Okay. 70 and a half. 70 and a half. All subsequent RMDs, so once you go beyond 70 and a half, are December 31st of all subsequent years. So with the new rules, we don't have to worry about any of this stuff anymore. And the reason we don't have to worry about it is because under the new rules, you don't have to do anything to fulfill your required minimum distribution. TSP is going to take care of it for you. Every December, we're going to look at the account information of all participants and automatically send a one-time check or electronic transfer to that participant. Now, what if you're already signed up for installment payments? Let's say you're already receiving $1,000 per month. That equals $12,000 for a year. If that $12,000 you've already received is greater than what the IRS requires you to take out for the RMD, you're good to go. You don't have to do anything else. If it's less than the amount that the IRS requires you to take out, we're automatically going to send you a 13th check, and it's going to be the difference from what you've already received and what the IRS requires. So basically what I'm sharing with you all is with the new rules in place, the RMD is foolproof. You cannot miss it. It's always going to be there for you every December. The only time you would need to do anything differently is if you want to receive that payment another time, or if you've already taken money out of your account through partial withdrawals, or monthly installment, or quarterly, semi-annual installment payments. The chart that I have up right here, you all, is called the single life table. This table is a table that we use to calculate your payments based on life expectancy. So this is the payments where you equal your RMD in 12 monthly equal payments, or you're using it to avoid the 10% early withdrawal penalty. So how does it work? You're going to find your age. So let's use 70. You're going to find your age, and you're going to take your account balance, the previous tax year, and you're going to divide it by 27.4. So if you had $100,000 in your TSP, and you turn 70 and a half, you're going to be required to take out $3,650 for that year. Does that make sense, everyone? So for your RMD, you're going to take your previous year's account balance and divide it by the distribution period, which is 27.4, or use the percent, which is 3.65. So that's how we calculate your RMD, and that's also how we calculate your life expectancy payments. Ma'am, did you have a question?
Yeah. It's assuming, I thought I heard you say at the beginning that you would automatically get the RMD sent to you. And that's assuming that all the funds that you would take, you would have to take out of your TSP. But if you've got an IRA floating someplace else, that, you know, and you prefer to take it out of that, can you stop the RMD from the TSP?
So the question for those who are not in a live audience, the lady is asking if you're able to commingle the RMD with outside IRAs as well, and the answer is no. 401ks and TSPs require separate RMDs. Now, IRAs on the outside, you can absolutely commingle it and take it out of one instead of all three. So let's say, for example, on the outside, you have 3 traditional IRAs. The RMD for the three of those combined, let's say, is $3,000. You can take that $3,000 out of one of those IRAs and leave the other 2 alone. That's perfectly fine. But you can't do that with your TSP. You can't say, well, I'm just going to take the $3,000 out of my TSP and leave those IRAs alone, because the rules are a little bit different when it comes to employer-sponsored plans in comparison to qualified accounts, and that's what a traditional IRA is. So what you would be able to do in that scenario is if you have 3 IRAs on the outside, you could take it out of one of them, but you still have to take it out of your TSP, unfortunately. Okay. Yes, ma'am. And a mic, please.
What is the distribution period? Is that the pay periods? You've got
That's how much longer you have to live.
27 years?
Yes, ma'am.
That's all I have?
That's it.
Okay.
That's it. So that's what the IRS is saying our life expectancy is. That's what your distribution period is. So again, you're going to take your account balance and divide it by the distribution period, and that's how you come up with your RMD. Now, remember you all, this is for the life expectancy payments, this chart here. This chart here is for your RMD. It's almost exactly the same, but the numbers are off a bit. So this is the table you're going to use for your RMD payments. But remember, we're taking care of it for you. And that's great news, everyone, because the old rules led a lot of participants to missing their RMD. And I'm here to tell you all, if you miss an RMD, it's one of the stiffest penalties in the IRS code. Does anyone know what the penalty is for missing an RMD payment? It's 50% of the amount required to take out. So if you were a TSP millionaire, you're going to have an $18,000 penalty for missing your RMD. And that's one of the reasons where we put this into place, where you no longer have to worry about it. Yes, sir.
Yeah, just make sure, you say it's taken care of automatically, but you said if the April 1st, you should do it, at the end of December. Is there a paperwork or something I got to initiate, or do you know my age and it truly is automatic, or what actions do I have to take when I'm 70.5 years old to get this thing going? And do I have to do it every year? Or is it one-time setup and RMD is taken care of? Or?
Sir, you don't even have a one-time setup. It's going to be automatically. The only time that you would need to submit paperwork is if you would rather receive an electronic distribution instead of a paper check. So we're going to send a paper check automatically. That's the default. You would have to go online and complete a form, and I believe it's the TSP 73. Don't quote me on that one. We may have to call TSP, the thrift line, to get the exact form. But again, you're good to go. So you have no worries. Once you're 70.5, it's taken care of unless you want it in a different time of the year other than December. Okay. Also with this table, I wanted you all to know with your RMDs, you all see that the distribution period, it goes down as we age. That means the amount is going up that we have to take out. So as we get into our late 80s, it's going to jump from 3% to 8% per year. And it's going to continue to go higher as we age. And then the IRS is going to give us a break, but we have to get to 115 years before they give us a break, and it goes down again. Yes, ma'am.
If your fixed distribution or, yeah, if your regular,
Installment payments, the monthly installment
yeah,
payments?
whatever you're getting on a regular basis, if they meet or exceed the RMD, is there still an RMD distribution in December?
No,
Or
ma'am.
Okay, so.
You're already covered.
You're covered.
Yep, you're already covered. So the question was, let me repeat that back to you all. If you're already receiving installment payments and they surpass the amount the IRS requires you to take out, you're good to go. You don't have to take any more money out of your account. And we check that for you, so you don't even have to worry about it. And that's why I say if it's less than the IRS amount, required amount, we're still going to send you a 13th check for the missing amount. So it's foolproof. It's covered for you.
Are these slides online on TSP.gov?
Can you share these?
I sent them out. I'll resend it. I sent it to everyone. I can email it to you.
Could you do that? You know what?
We can talk after.
Okay, everyone, we're wrapping up, but let's go over a couple of more slides, and I'm going to make sure we cover the age rules. So spouses' rights. Whenever we take money out of our TSP, if we're FERS employees, we have to get a notarized spouse's signature. There is an exception form. It's called a TSP 16. It's the #1 rejected form at TSP headquarters. And the reason it's being rejected is because we're getting a lot of scenarios that aren't exceptional, meaning we're getting a lot of my husband's at the grocery store or my wife is on vacation. Unfortunately, we got to wait for them to come back from the grocery store or come back from vacation to process this form. You know, when it comes to CSRS, you all don't have to worry about the spouse's signature, but we will notify your spouse. You got 2 weeks to get out of town because that's how long it takes for your spouse to receive that slip that we show how much you've taken out of your account. Why do we notify them? Because it's part of your benefits package, and that's what you signed up for. Well, not CSRS, that is. I don't know. You're asking me a tough question there. I might know everything else, but I don't know the answer to that one. CSRS, again, we won't require you to get your spouse's notarized signature, but we will notify them of the amount that came out of the account. All right, so the pro rata distribution rule. This is a rule that I hope we change in the future, and it is on the radar.
Hold on, I have a question from the field.
Okay.
Sorry about that. I am turning 62 in a few weeks. I plan on working a few more years. Does it make sense to collect Social Security and take that amount of money and deposit it into my TSP? I realize that I can deposit from external accounts, but say the amount is $600. Can I collect that and take the $600 out of my paycheck and put it into TSP?
That's a loaded question, but let me answer it for you. In order to make contributions to an IRA, you have to have earned income. So if the gentleman doesn't have earned income, which Social Security isn't considered earned income, he's not going to be able to take that $600 and put it into an IRA and then transfer that IRA into his TSP. Now, what if he's receiving $600 from Social Security, but he also has a part-time job where he's generating $1,000 a month? Well, in that scenario, he could take the $600 and put it into his TSP or an IRA because that covers the $600 he would like to put into the account. So we don't care where the money comes from. We don't care if it's coming from your pension or if it's coming from Social Security. All we care is that, the IRS cares that you have earned income to show that you've earned that amount to contribute it to your TSP. Does that make sense, everyone? So in order to contribute $600 into an IRA, we have to see that you have at least $600 of earned income. The $600 that you earn from Social Security isn't going to get it. You're going to have earned income from an employer. So that would be the answer to the question. Okay. It's not earned income, no ma'am. But again, if you have $600 of earned income to cover it, you could take it from Social Security and put it into the IRA and then into your TSP account. So this is a rule we didn't change. Maybe we're going to change it the next updates. This is a pro rata distribution rule. And basically what we're saying here is your distributions are going to mirror your current allocation on TSP.gov. So again, if you're 30% in the C fund and you take out $10,000, $3,000 is going to come from the C fund. You can't say to us, I just want my money to come out of the G fund and leave the rest where it is. It comes out pro rata. So it's going to look just like your allocation as it comes out. We are looking at that rule because it makes a lot of sense, especially if the market is down, to take it out of the G fund instead of realizing a loss out of the C, the S, and the I fund. But again, we haven't made that change just yet, so bear with us. For the longest time, yes, ma'am. I don't. I don't have, the question was, do I have an estimate of when that will go into place? And I don't. We're talking about it at the headquarters, but there are no firm dates. So I can't say this year, next year, or even a year after. But I'm with you, ma'am. The sooner the better when it comes to that rule. Now, this slide here, for the longest time, I had no clue why we use it in our presentation until I went to FDIC, Federal Deposit Insurance Corporation. Okay. So I went to FDIC, and a participant came up to me after the presentation, and she had just used an age-based withdrawal. Does anyone remember when that age-based withdrawal becomes available? 59 and a half. It becomes available at 59 and a half. So she had just used an age-based withdrawal. She was working with a financial planner, and she had transferred a portion of her TSP balance over to an IRA on the outside to purchase an annuity. And what she shared with me was, she said she received 2 checks. One check went directly to the annuity company, but the other check came to her. And she asked me, why did that happen? And I was clueless for a second, and then I asked her, hey, did you have 2 tax treatments in your account? Did you have traditional money and Roth money? And she said, yes. So that answered my question. So what happened, the reason she received a check made payable to her is under the old rules, if you had 2 tax treatments, you had to provide us a traditional IRA account number, and you also had to provide us a Roth IRA account number. Because remember, with the old rules, you couldn't choose which tax treatment you're taking from. You could only choose pro rata. So her money came from both tax treatments. So one went directly to her annuity, but the other came to her because she didn't provide us a Roth IRA account number. So her Roth money went straight to her. The good news is she was over 59 and a half, so the money was tax-free, and then she didn't have any tax liability. Does that make sense, everyone? So again, if you have both tax treatments, under the old rules, if you made a distribution, you have to give us 2 account numbers because the traditional money goes to traditional and the Roth money goes to Roth. The great news is, with the new rules, you aren't required to do a pro rata distribution. You can say to us just traditional. You can say to us just Roth, so that scenario will never happen again with these new rules in effect. Yes, sir.
Yeah, last year, attending one of these classes, I learned first time about Roth, TSP Roth. They said, oh yeah, you can transfer it over. I've been to the website, I called your numbers. Seemed like nobody knows how to get that going. Is there some instructions that I can go to put money in to establish a Roth account?
So
because I don't know how to do it.
So to establish your Roth TSP?
Right.
It's just through your employer's payroll system. So you're going to log into your employee's payroll system, and from there, it's going to have a block for traditional, and it's going to have a block for Roth as well.
Yeah, I can't.
Well, you should be able to do it both ways. You should be able to do it on a paper form, which is the TSP-1 form, but you should also be able to do it on your payroll system. So it's a personal choice on which one works the best for you.
No, I know it's a personal choice. I like to do it. I just can't do it, and nobody seems to know how to help me to do it. I'll try it going online.
Yeah. Does anyone know what your employee's payroll system is? I know at my agency we use Employee Express. So you all use EPP. So that's where you would want to go, sir, to sign up for your Roth and your traditional contributions. And sir, we can talk after the presentation as well. I'll give you some tips on it. Mike.
Is the TSP considered and I'm confused because I took another class and I should have asked the question then, but is the TSP account considered a traditional IRA?
No.
It is separate.
It's totally separate. And a lot of people are confused on the differences.
Yes.
Remember, the TSP is a TSP.
Okay.
The IRA is an IRA.
Okay.
They're not the same. TSP is available for all federal employees. regardless of income restrictions. Everyone can contribute to traditional or Roth TSP regardless of income restrictions. That's TSP. IRAs can be opened at banks, credit unions, and investment companies, not at TSP. You have Roth IRAs, and you also have traditional IRAs. They have nothing to do with your TSP. They are also based on your income. So not all of us can make contributions to IRAs because we either make too much money or we don't have earned income.
Well, the reason I'm asking that, because HUD has, you can open up a traditional, you can open up a Roth. I was just told that the TSP is traditional. And I'm like, that's confusing.
Yeah.
So I did open up a traditional and a Roth, and I was thinking that my TSP was a traditional, but I looked at the account amount in there, and I'm like, no, this could be traditional. So with HUD, the traditional I can put into my TSP, but the Roth,
Correct.
okay.
Correct. So yes, you can bring traditional IRAs into your traditional TSP with this agency, but you can't move over a Roth IRA and put it into your Roth TSP. So remember, IRAs are totally separate than TSPs. They're two different contributions limits. If you fall within the income restrictions, you can make contributions to them both. Yeah. No worries. And after the presentation, if you want to clear it up even more, we could talk one-on-one.
So I'm thinking that you may be confused because, could you go back to the other slide? Because we have two different TSP accounts, obviously, that you could choose from, right?
Well, you only have one TSP account, but you have two tax treatments that you're able to have in it.
And one is traditional and one is Roth. And the traditional is just, I'm just talking to her, it's TSP. It has nothing to do with IRA. It's just that it's a traditional track. And then there's a Roth track.
Correct.
Well, right, they're not IRAs.
You know what? Let's move past this, and ma'am, I'll get with you after the break. Okay. So let's talk about one of the most important slides in the presentation. So ma'am, this is the question you had about the ages. So how do we avoid the 10% early withdrawal penalty? Well, the easiest way, just wait until you're 59 and a half. You don't have to worry about it. But let's talk about the other rules, which we really care about, especially the second bullet. The second bullet says this: if we separate or retire in the calendar year that we turn 55 or beyond, we avoid the 10% early withdrawal penalty. So let me say that one more time because I'm going to quiz you all. If we separate or retire in the calendar year that we turn 55, we don't even have to be 55. We can be 54, about to turn 55, as long as it's within that calendar year. We avoid the 10% early withdrawal penalty in all subsequent years. So you all ready for the quiz, or you want me to say it one more time? One more time. Okay. If you separate or retire in the calendar year that you turn 55, you avoid the 10% early withdrawal penalty in all subsequent years beyond 55. And you don't even have to be 55. It could be 54 the year that you turn 55. All right, so here's a quiz. I'm going to ask you all 4 questions. The first question is, you retire at 57. You decide to leave your TSP behind. You don't need the money just yet. You come back at 65. You start to make a withdrawal. Would you be able to avoid the penalty at 55 or 59 and a half in that scenario? You retired at 57. The answer was 55. I tried to trick you all by throwing 65 in there. 65 had nothing to do with the scenario. I learned that from my math classes. They always throw something in that has nothing to do with the problem. Okay, so the answer would be 55 for that one. Here's another one. Let's say you retire at 50, but you leave your money in the TSP because you can say with TSP for life, you don't need it right away. You come back to TSP at 57, and then you go to make a withdrawal. Would you be able to avoid the 10% penalty at 55 or 59 and a half in that scenario? 55. No, let me say it one more time. You retired at 50. You leave your TSP behind. You come back at 57 to make your first distribution. With that scenario, you would have to wait until 59 and a half. The reason why is you retired before you were 55. So now you have to wait until 59 and a half. All right, here's another one. You retire when you're 54, but you're going to turn 55 before the end of the year. And you're going to make the withdrawal that same year. Would you be able to avoid the penalty at 55 or 59 and a half? 55, absolutely, you all are right. Let me give you all an easy one. All right, you retire at 59, and you want to make a withdrawal right away. Would you be able to avoid the penalty at 55 or 59 and a half? No, 55. Remember, I said you have to retire at 55. In that scenario, I said you retired at 59. So you avoid the penalty at 55. Here's the last one. You retire at 57, but you've been working with a financial planner. He says, bring the money over to my IRA. So you do so. The money gets into the IRA. You're still 57. You make a distribution. Would you be able to go by 55 or 59 and a half? I tricked you all. It's 59 and a half. IRAs don't go by the same rules as 401ks and TSPs. And I shared that with you all intentionally. Don't let the financial planner trick you into moving money to an IRA if you're only 57, 58, 56, even 59, because you're now going to have to wait until 59 and a half before you avoid the 10% early withdrawal penalty. All right, so you all passed with flying colors. Good job, everybody. All right, so let's talk about the other options. TSP monthly payments based on life expectancy. We already talked about this one. That avoids the 10% payment. Annuity payments avoid the 10% payment because it no longer belongs to you. The IRS gives you the exception. Ordered by domestic relations court orders, basically, you avoid the 10% penalty. If you pass away, you avoid the 10% penalty. I'm joking, everybody. That's based on your beneficiaries. Regardless of their age, if they inherit the account, when they take money out, they don't have a 10% early withdrawal penalty. So whenever you inherit money based on death, regardless of your age, when you take money out, you no longer have a 10% early withdrawal penalty. And they don't have to be 55 at all. From a beneficiary participant account, we're going to talk about that in a second. And the last two reasons, make sure you're working with an enrolled agent or a CBA who specializes in taxes, because you're going to have some additional tax forms to complete in order to make those transactions seamless. So, ma'am, I want to come back to you in the back row. Did I answer your questions with this, or did you have an additional question? No penalty. Okay, good to go. Okay, death benefits. So the process. So in order to start the process, we're going to have to send in a TSP 17 form. Let me back up for a second. I guess it won't be us submitting that form. Right. So it's going to be our participants who are our beneficiaries that are going to submit that form. That's the form that's going to expedite the process to get the payouts to our beneficiaries. And we are aware of the passing away of some federal employees because we have databases that will alert us, but this will expedite the process. We need the TSP 17 along with the death certificate, and we'll be able to get that money paid out to you. The other form that you have to be aware of is a TSP 3, and most of us have used that form before. This is the form we're going to use to name our beneficiaries. Be sure to update your beneficiaries, especially after certain life events. Marriage, especially divorce. We definitely don't want money to go to the ex-spouses, the birth of a child, et cetera, et cetera. Now, with that TSP 3, if you don't complete it, we're going to go by the statutory order of precedence. The statutory order of precedence is your spouse, then your natural and adopted children. Stepchildren are not included unless they're adopted. Then it goes to the parents, then the estate, and then the next of kin. It goes in that order for the statutory order of precedence. If you don't like any of those people, just complete the TSP 3, name who you would like to receive the funds in your account. Yes, sir.
Okay, I'm assuming then when I die, my wife can't keep the money in the TSP and continue working with the TSP. It all has to come out into her account?
So let's talk about that now. So I'm going to go over the section for spouse beneficiaries and what the process looks like. It's called BPA, which stands for Beneficiary Participant Account. It's for spouses only. If your spouse is named your beneficiary, they're going to be able to stay with TSP even if they're not a federal employee. For spouses only. So how will that process look? Well, first we'll see that your spouse is a beneficiary. From there, we're going to send them a condolences package, and it's going to be their new account number and all the rules of their new TSP account. It's going to be known as that beneficiary participant account. They're also going to be defaulted to the life cycle fund, which matches up with the year that they turn 63. If they're already 63, we're going to put them in what's called the L income fund. Now, with that said, they still are going to have the same options available to regular federal employees, meaning they can still make investment strategy changes twice per month. And after that second transaction, they can make additional changes, but only to the G fund. And then it resets the first of every month. Now, the differences with the BPA account, remember, they don't have a 10% early withdrawal penalty, regardless of their age. Another difference that's not so great is once they name a beneficiary, the only option those beneficiaries will have is 100% cash out. So that could be a nightmare for your new beneficiary if you decide to leave it with TSP in that BPA account. Now, here are some instances. If you're also married to a federal employee, they may be able to, well, they are able to combine their account with the BPA account, or the BPA account is merged with their own account. Now, with that said, you may not want to do that. There's a couple of reasons why I wouldn't do that. The first is, if I'm not 55 or 59 and a half, I'm not merging the accounts together. Because when I merge them together, now I have to wait until I reach that age before I avoid the 10% penalty. Remember, if you left it separate, you could take money out without penalty at 40, 45, 50, et cetera. So I wouldn't merge it if I'm not quite at 55 or 59 and a half. Another reason I would not merge the accounts is if the deceased was younger than the owner of the account. So let's use me as, no, I don't want to use myself as the example. Let's use Henry as an example. Let's say Henry passes away at 60 years old, but the spouse was 70 at the time. In that scenario, I would not want to merge the accounts. The reason I wouldn't want to merge the accounts is once my wife turns 70 and a half, she doesn't have to start taking an RMD out of my account because I was 10 years younger than her. So she would be able to wait until 80 before she's required to take money out of the account that I left behind to her. So I wouldn't merge them together in that instance. The only instance I would merge the accounts together if my spouse was a federal employee is if I'm already at RMD age, but I continue to work. At that point, I would merge them together because that's going to allow me to defer RMD for both accounts. So I hope that makes sense for everyone. So these are the rules for spousal beneficiaries. Remember, spouses only. So what about non-spouse beneficiaries, everyone else? And this is what I would have to do because my son is named my beneficiary. So what happens if I were to pass away? Well, unfortunately, my son can't stay with TSP, nor could my cousin, nor could my friend. It has to, a spouse is the only person that can stay with TSP. Now, what would my son be required to do? Number one, he would be able to do 100% withdrawal all at once, which he would love, and he would pay taxes on it all at once. But the option I would like him to take advantage of is to go to a local bank, credit union, or investment company and open up what's called an inherited IRA. Now, with an inherited IRA, my son is still going to have to take money out following my death, the year after my death, regardless of his age. Even if my son was 18, he would still be required to take money out of that account for the rest of his life if I leave that money towards him. The good news is it's a smaller amount. It's probably going to be 1 to 2% of the account balance. And remember, it avoids the 10% early withdrawal penalty. So hopefully he'll get a head start when it comes to retirement. Does anyone have any questions about the BPA account or the inherited IRA or full distributions for non-spouse beneficiaries?
Just the inherited IRA has the RMD, even if the participant hadn't reached 70 and a half.
It does.
Okay.
It does. So,
Okay.
so let me clarify that statement. And that's a great statement that the lady shared. Regardless of your age, if you inherited an account from a qualified plan like TSP, you're going to have an RMD regardless of your age that starts April 1st following the death of the deceased. So again, if you inherited an account from a TSP or an IRA, regardless of the age, you're going to have an RMD starting April 1st following the year of the account owner. Yes, ma'am.
So could your son, let's say he's fully employed and have a some kind of a 401k plan himself, can he just directly roll over your money that you left him to his plan?
He wouldn't be able to, unfortunately.
wouldn't?
And the reason why he wouldn't be able to is because of what the previous question was. If we commingle the monies together, we don't know what portion is required to come out and what portion is not due to come out just yet. So unfortunately, you're limited on what you can do with an inherited account because you have to start taking money out of it that April 1st following the deceased death.
But let's say he didn't have an inherited, like he doesn't set up that inheritance IRA, he just gets a check.
Okay, so that's a great scenario, so I'm glad you bring that up. So let's say he just receives a check and he's paying taxes on it all at once. Could he take that money he's paid taxes on and contribute to an IRA? He absolutely could, but think about it this way. The IRAs only have small contribution limits, $6,000 per year. So he wouldn't be able to take the entire lump sum and put it into an IRA, but if he has earned income, he could say, I'm going to take $6,000 and put it into this IRA, and he could do $6,000 every year.
What if he's like with a local or state, like a 457B or something? Would he be able to put the whole thing over there? He still wouldn't.
Still
be able
can't
to?
commingle it. Yeah, you're really limited with inherited IRAs because the IRS wants to keep track of those required minimum distributions regardless of your age. What time do we have? 2:55. Okay, I'm wrapping up now. All right, everyone, I'm wrapping up, but I want to go over some quick scenarios. Did you have a question, ma'am?
Yeah, I apologize. I think I know the answer. The 20% minimum required withholding, automatic withholding, when you take a cash payout, that is an upfront tax payment or tax withholding when you do your taxes at the end of the year. If you actually owe less than that, you get a refund, correct?
Yes, ma'am. And make sure you verify that with the tax planner. I have to say that. That's my disclaimer. But yes, ma'am, you're absolutely right. Okay, everyone, let's go over this scenario. So these scenarios were based on the old rules, but they still apply to the new rules. So the first one we have is Gary. So Gary is 70 years old. He's been retired, living comfortably on his CSRS pension. He will soon be required to start receiving income from his TSP. Sounds like he's at RMD age. But he would like to take only the required minimum amount. With everything that we talked about today, what could he use, what withdrawal option could he use to fulfill his need? Life expectancy, that's it. He could do monthly payments based on life expectancy, and he's going to receive 12 equal payments that equal exactly what his RMD is. But what's another option under the new rules? What does he have to do under the new rules to get that RMD payment? I was looking for that. That was a trick question. He doesn't have to do anything because he's going to receive it automatically. So with the new rules, he could either do several things. He could do nothing, receive it every December. He could sign up for TSP life expectancy payments, get 12 monthly payments, and 12 equal payments that equal to RMD, or he could just sign up for installment payments and take out whatever he needs to take out. And if it's not what the IRS requires, we still are going to send you a 13th check. So you're still covered. But what if you don't have an installment payment? What if you took one partial withdrawal for $12,000 over the year? Well, guess what? That still covers your RMD. If it's less, we're going to send you the difference. So you're protected when it comes to that RMD. All right, so Brenda is going to retire at age 60. She believes her first pension and Social Security would support her retirement lifestyle if only she could eliminate that mortgage. So what could she do to cover that mortgage concern that we talked about in the presentation? That's it. She could do installment payments for the dollar amount of the mortgage. Or she could take partial withdrawals into multiple years so she doesn't bump herself into the highest tax bracket all at once. Or if she wants to, maybe it's not a large mortgage, she could just take a distribution and pay off the mortgage, but I wouldn't do that unless it's a smaller amount. Last but not least, we have Barbara. Barbara is retiring at age 66. She's not sure whether she will need income from the TSP to maintain her retirement lifestyle. She has a young grandson and she wants to help him with his education funding. So she has two concerns. And this is a tough one, everyone, so I don't expect anyone to get this. But does anyone have any ideas of what she could do to meet her two needs? So one thing is this. Retirement is an unknown, and she's not sure if she's going to be okay. The other is she wants to take care of her grandson when it comes to education. So what do you all think? What could she do using TSP? You almost hit it dead on the nose. Yeah, you almost hit it dead on the nose. So what the lady shared was, ma'am, could you say that again? So she said for herself, she could do a life expectancy payment. And so for her grandson, she could do a distribution. And basically, with that distribution, she can open what's called a 529 college savings plan. Of course, she can't open that at TSP, but she could go to the local state plan for the state, because usually you get a tax benefit as well. But be sure to confirm that with your tax representatives. But let me give the canned answer for this question. So to take care of her retirement need, what she could do is take a distribution and transfer it over to an IRA at a bank, credit union, or investment company. Remember I mentioned that earlier, where that would serve as a backup account for her, just in case the need came up and she could get her hands on that money that day. So that's what she could do for herself, or as the lady said, she could do installment payments based on life expectancy. And for her grandson, she would definitely do what the lady said and make a distribution and then transfer that to a college account or go directly to the college. Everyone, I believe that ends my presentation. Just to go over some quick things with you all. One quick thing with you all, though, before we wrap up. One thing I wanted to make aware, if you have a loan outstanding, if you go into retirement, you're going to have 90 days to fulfill that loan. If that loan isn't paid off within that 90 days, you're going to receive a taxable event. And if you're not 59 and a half, you're also going to have a 10% early withdrawal penalty. And yes, sir.
3 questions for 2020.
Oops.
What is the maximum amount for this next coming year? I can't find any literature on that. And what's the catch-up of maximum amount? And what pay period do we initiate it in?
So the IRS releases the next calendar year information in October. It's not released just yet. I know we're in October. The last time I checked, it wasn't released.
Where should we what should I monitor this?
IRS.gov. It pops up on their homepage, so that's where I would go. Everyone, I want to thank you all for your time this afternoon. I'm going to stick around as long as you all need me to answer any questions you may have, but best of luck to you all on your journey to become TSP millionaires. Thank you. You're welcome. You're welcome.